So very good afternoon. So today is the session 3. Today is the session 3 for the subject financial management. First 2 sessions we have completed. Complete introduction to the FM with a chapter called as time value of money. Hope everyone understood all the concepts of time value of money clearly. So anyway, every single day starting from the last 2 days before class till the last class, one common question: what is the value of asset? What is the value of an asset? Present value of future cash flows discounted at a required rate of return. Okay, so that's called as a value of an asset. So value of an asset is present value of future cash flows discounted at required rate of return. So that's what we have seen. After that, once value of asset is taken, there are 3 elements inside that. One is a life, second one is a cash flow, third one will be required rate. Life of an asset will be always subjected to the discussion. First one, if it is a real asset, life will be almost accurate. If it is a debenture type of instrument, 100% accurate. And if it is any other financial instrument like equity share, life becomes very much difficult because the life is running till perpetuity. So this is a thing we have done in the previous sessions. Next, after that we have understood the types of cash flows. One is called as a discounted cash flow, another one is a compounded cash flow. Discounting is a concept of bringing the future to present, and compound. We'll change the mic. 1 minute. So see here. We came to know that there will be 2 types of cash flows. One is called as a discounted cash flow, another one is a compounded cash flows. Discounting is a concept of bringing the future to present, and the compounding is a concept of taking the present to future. And after that we have seen some cash flow streams. Yesterday's discussion completely made on that. The first type is called as a single cash flow, second type is called as annuity cash flow, third one multiple uneven cash flow, and fourth one will be perpetual or multiple uneven and annuity. So 4 kinds of cash flows will be there. First type of cash flow is a single cash flow where only one cash inflow will come, that too in a future time. For that the formula will be FV divided by 1 plus R whole power n. Logic of the formula, meaning, intention, everything we have completed already. Clear? And next one, after that we read about a concept called as annuity cash flow. Annuity cash flow concept of what we said is a single cash flow will come, but for a multiple periods the same cash flow will get repeated. Those kind of cash flows are called as multiple even cash flows, also called as annuity cash flows. So annuity cash flows is the second type of cash flow we have covered. So once after the covering that particular concept, we went into multiple uneven cash flows. Single cash flows coming in a stream, but they will come in a uneven order. 1 year 1 lakh, another year 2 lakh, another year 1 lakh 50, next year 78,000. Uneven cash flows will fall. So those kind of concepts are called as multiple uneven cash flows. Capital budgeting 90% will be filled with multiple uneven cash flows, because plant and machinery can't create same sales every year. Okay, it will change. So capital budgeting is completely filled with either with multiple uneven or with annuity. These are the 2 types of cash flows which comes in capital budgeting. Okay, next issue after that. So perpetual cash flows, I said that we are going to discuss in the first chapter itself, called as cost of capital. At appropriate place we will be discussing about that. This is the point that we completed in the previous classes. But one very important thing, the importance of reinvestment. Importance of yesterday's flag end of the class we have done one illustration. Which is better, receiving 1 rupee for 3 years is better, or receiving 3 rupees at the end of 3 years is better? Which is better? Which is better? 1 rupee is better, because it is possible of being reinvested in the intermittent periods. First year cash flow can be reinvested for 2 years, second year cash flow can be reinvested for 1 year, third year you will directly take. On a basic comparison you can tell now. 1. Last year you are receiving 3. We made comparison between both of them or not? First year 1 rupee, if you reinvest itself, output will be more than 3. 1. Totally so much? Answer. Second type, Third year ending, how much it is giving? Now 3 rupees only. Now we are going to compare. Which 3 is better is a question now. Actually 3 rupees and 3 rupees both are having same value or not? But not in FM. In FM, both 3 rupees are not one and the same. First type of 3 rupee is not just 3, it will be compounded for interest also. Clear? First 1 rupee will be? First 1 rupee will be? First 1 rupee will be reinvested for? That 1 rupee will be 1 rupee. That 1 rupee will be more than 1. By the end of third year. By the end of third year, that 1 rupee is not 1 rupee. That 1 rupee is reinvested twice with the same rate. Clear? 1, 1, 1. How much? Directly it is. We compared both of them. First one, 1, 1, 1. Totally how much? Versus 3 at the end of third year. If you ask a normal person, they will tell both are same. But finance student or financial management don't tell like that. This 3 and this 3 both are not one and the same, because first 3 without reinvestment it is equal to 3. Without reinvestment it is 3. If you reinvest, at least 1 paisa higher than 3 will come or not. By seeing the question you can tell which is better. Are you understanding the concept or not? First option 1, 1, 1, making total. Second option, total 3. When you make a normal comparison, both are equal. Clear? But the second type of cash flow, reinvestment possibility there or not there? Why? If you don't answer, I will repeat once again. That's all. Nothing I will do. Your time only will get wasted. Tell me, the next 3 years, can I reinvest or cannot? Why? It is received at the end of third year. I can't reinvest. 0 years available. Clear or not? So I will directly take. Second option, how much will be there in my hand? Answer. First option, how much will be there without reinvestment? If I reinvest, at least 1 paisa higher will come or not? By directly by seeing the question, you can tell first option is better. So in life, what is the moral of the story we learned in the yesterday's class? How much big you earn is not important. Small you earn, but reinvest properly, you will be bigger than a rich person. Are you understanding the point or not? It is not about how much you get. It is all about how you are doing the money investments. So reinvestment is always giving a big return than getting a big cash flow. Futuristic big cash flow is always inferior to present small cash flow. Because this present small cash flow can be reinvested. Provided you do reinvestment, all these magics will happen. If you sit them idly, or if you are doing something with that unnecessarily without reinvesting them, gone. Are you understanding the point or not? Listening or not, everyone? Reinvestment means where to reinvest? Where to reinvest? Answer, where to reinvest? Ade, same rate where to reinvest? Can you give an example? Where can I invest? Need not be. That is the point. That's a problem all the way. People think reinvestment. Investment means bank, stock market, mutual funds. I get money. Listening? I get money. Once I get money, I will invest in my iPad. What will happen? Let me explain. A work which I can do in 2 hours, this will get it done in 1 hour. And shall I tell you one point? We are selling CA final SFM books. I made a print of around 1000 books in the last month. It came to around 390 or 370 now. Each book cost is 750, both books 1500. This cost is 1,50,000. First 100 books then I got returned back. Are you understanding the point or not? Did you understand what I said? I will show you an example. See here, maybe out of it you can understand. We prepared a book this way. See here. This is CA Inter. Finally, already it was there. Book print also over, sale also started. Almost books also getting over. Moral of the story. People, when I purchased the iPad new one, it is around 1,58,000 when I purchased in the last 4 or 5 months back. People asked me, already you have one, why you are doing? That became a little slow. So I am going for an advanced one. They also asked, Are you can use it. Most of them are using like that. Most of them, let them use. Why unnecessarily 1,50,000? Fool only will think, why unnecessarily 1,50,000? My return on investment is 200%. Are you understanding the point or not? After buying this, 2 books we released. 750, 1,500. Listening, huh? If 1,000 books are sold, what is the revenue? 15 lakhs. What is the cost? Who is a fool? Did you understand my point or not? What said? So yes, definitely. Definitely, you are guaranteed. So, the point is, listen, first point number 1 is, return on investment means it does not always mean you have to reinvest in a bank, reinvest in a stock market, reinvest in somewhere. It doesn't mean that. Reinvestment means any place which can give you a guaranteed return. Are you understanding the point or not? Yes, I purchase something. Like a fool, I will not buy, though you do. First I will see what is the use with this, what help it will do me. So this is what I am investing. Will this do any automation work? Are you understanding the point or not? Simply to tell, I can give you some examples. When I write the answers on the book, I mean on the iPad, see there, these are all electrotyped. That means when I draw the square, automatically it will only complete the box. Means with a normal paper and a pen, if I have to do all these things, I have to draw a box. I have to color them. How many colors I have to do? Then I will become artist. After some number of days, I will become artist. So it is impossible. I am telling you, highly impossible. In law language, supervening impossibility. You can't do this. Impossible. 1 page you will do, 10 pages you will do, 20 pages you will do. After that, are you understanding the point or not? And it should be in a handwritten font. All these, it will serve only one thing, it can serve my purpose. And that's the Apple iPad. So I can really tell that the investment never got wasted. This investment of 1,50,000 has given me a return of 15 lakhs. Now answer my question. I am getting a 10% return. Then I got profit. I reinvested in a laptop or an iPad. It is giving me 15 lakhs. I am getting 10% return. I am getting 100 times of returns. To be very frank, that is the returns that we get out of it. So never think that reinvestment means you should reinvest only in bank, stock market, etc. Are you guaranteed that book will definitely get sold? Yes, it will be really helpful, it will get sold. With that confidence we have done, and that was successful. So the point what I want to tell is, don't be in a wrong impression that reinvestment means only bank, stock exchange, mutual funds, post office deposits. No. Any place which gives you more than what you invested. Are you understanding or not? Yes, answer. Yes, listening everyone? So, sir, they purchased cameras, they will purchase computer systems, I mean case account, they will invest on camera. Cameras will be in lakhs obviously. So, when they invest thousands and lakhs, with what intention they will do? Generally, anyone will put an expenditure, that the expenditure should generate revenue. Income don't call. In this FM, we don't have incomes. Are you understanding or not? Cash inflow, cash outflow, that's all. Incomes, expenses, do that in DT class. So, this will generate some revenue, which is eventually a cash flow for them. Are you listening or not? Yes, that means they will count, okay, this much expenditure we kept. At least this much revenue should come in order to cross the investment. After investment, everything is a profit. Clear? So therefore, try to understand clearly. Reinvestment does not mean investment in banks. Reinvestment means investing in projects. This is the thing you need to learn. Reinvestment do not mean reinvestment in banks. Reinvestment means reinvestment in project. Are you understanding or not? I invested in education project. You invest in some other project. The project may change, but the investment will always go inside a project. Clear, everyone in the class? Before even going into that, tell me, receiving one rupee for 3 years is better, or receiving 3 rupees at the end of third year is better? Bigger cash flows are better, consistent cash flows are better, are always better than bigger cash flows, because they are possible of being reinvested. Understood the point clearly or not? So this is the main point that we need to discuss in this particular area. Shall we continue further? Okay, lastly, yesterday where you stopped? What is the last point you have written yesterday? One second. Up to here you have written, right? See the screen once. Up to here you have written in the last class, right? Now tell me, up to here if you write year cash flow, balance number of years 210, reinvestment maturity value. There whatever the workings we have done, everyone understood? Yes, write down one last notes on that. We'll go to the first chapter, cost of capital. Keep the heading notes. Write down clearly there. Keep the heading notes. Write down. Receiving 1 rupee each in all the 3 years. Receiving 1 rupee each in all the 3 years. Receiving 1 rupee each in all the 3 years is better than receiving 3 rupees at the end of third year. Is better than receiving 3 rupees at the end of third year, because in the first case rupee 1 cash flow is reinvested. Rupee 1 cash flow is reinvested, which in turn gives return. So which in turn gives return. Everyone understood up to here clearly? Done. So now the first, next, put below, that's a point number 1. Point number 2. To conclude, receiving small cash flows consistently every year is better than receiving bigger cash flows at times. Completed? So rather than receiving bigger cash flows at times, once in 3 years, 4 years, receiving consistent smaller cash flows is better, and that's the proof. Clear? Okay, full stop, continue. The impact of reinvestment will be analyzed in depth. The impact of reinvestment will be analyzed in depth in chapter 3. In chapter 3, what is the name of the chapter? Capital budgeting. In the chapter 3, keep a dash and write capital budgeting. Completed, everyone? Shall we continue? This is the thing that we have completed now. Next important issue that we are going to start is the first chapter. What is the name of the chapter? Cost of capital. I will show you the study mat also. Everyone have the study mats with you? Yes. So put the heading, the chapter 1, cost of capital. Cost of capital. Every chapter will have learning objectives. Once we complete all the learning objectives, then we will move on into the next chapter. Keep the heading cost of capital, learning objectives. Cost of capital. Shall we continue? Okay. First, write down the learning objectives of this chapter. Introduction and the basic concept of financing. Concept of cost of capital. I am reading just what are the contents. Basic meanings of certain technical terms. Cost of debt. Cost of preference shares. Cost of equity. Cost of reserves. Calculation of cost of debt using approximate formula, using IRR. Understanding the full concept of debt valuation with a derivation to formula. Understanding flotation costs, calculation of cost of preference shares, calculation of cost of equity. Various issues governing cost of equity, calculation of weighted average cost of capital, calculation of weighted average cost of capital using book value weights and market value weights. These are the various concepts. I am making it full screen. Please copy down. Write down. Learning objectives. Number 1, introduction and basic concept of financing. Concept of cost of capital. First three completed. First two. So completed. Completed, everyone. So first one, the concept of understanding the financing approach is the first learning objective we need to clear. Once you are done, I can start. Over. So make it fast, please. In the first session, if you remember, we have seen one word called as a weighted average cost of capital. Yes or no? That answers we will get in this chapter. Every formula meaning also we will derive in this particular chapter, cost of capital. Listen first, cost of capital is the base for understanding the entire CA inter FM. CA inter FM ki base cost of capital. Listening everyone? Advancement will be made in the form of dividends. After that we will see the chapter called as capital budgeting. Without understanding time value of money, without understanding cost of capital, you can't start with capital budgeting. Listening everyone, most of the concepts which you read in cost of capital and time value of money will get repeated in the chapter called as capital budgeting. Listening everyone. So horrible concept of capital budgeting. So please, you should be taking enough care at the foundation and basics. Shall we start? So please everyone, after writing this, see this, don't write. Once everything is completed, I will only give time for you to copy. Please see the screen once. So if you see the screen clearly, please see there. So if you see the screen, there they said very clearly that financial needs and the sources of finance. Simply to tell, to run any kind of company, we can finance our company needs under two sources. Very important two sources. One is the owner funds, another one is a debt fund. See the screen or the TV please. Every business will finance itself using two sources, owner fund, debt fund. First one, owner fund, debt fund. Owners are again divided into two types, equity, preference. Debt can be of any form, debentures you call, bonds you call, loans you call, everything will be called with a one common name called as what? Debt. So listen carefully. Simply to bifurcate furthermore, there are three sources of finance, equity, preference, debt. Repetition one more time. Equity, preference and debt are the three sources of So in entire FM, not FM for that case, SFM completely, there are only three sources of financing. Number one is a equity, number two is a preference, number three is a debt. First one should understand meanings of the three sources of financing. What is equity? What are its characters? What is debt? What are its characters? What is a preference? What are its characters? First we need to understand that. If you observe clearly, everyone in the class listen, balance sheet will have two things. Number one, balance sheet will have two things. Number one, number two, sorry, number one assets liability or number one liabilities, any order can be anything. There will be only two items. Number one, second one, two things are there. Okay, now listen carefully. Liability creates an asset or asset creates a liability. SFM completely deals with liabilities, not on assets. Clear? The entire subject of financial management itself concentrates only on one thing. What is that? Liability. In that liability, two types are there. Owner's liability, outside liability. First one. We are now going to see the combination of both. Owner liability, outside liability put together we call as a total liability. This chapter is completely about liabilities analysis. We don't even touch the assets. Clear everyone? Yes, is there any chapter which touch assets? Capital budgeting. Capital budgeting concentrates on what? Why? Tell me, you raise funds using what? You raise funds using how many sources? See the screen and tell. Everyone. Number one. Number two. Number three. You raise money or not? Put it in dustbin. What you have to do? Invest. Invest in what? How many types of assets are there? First one. Second one. That first one being fixed asset will be dealt by a chapter called as a capital budgeting. Second, current assets is dealt by working capital management. That's how 2 chapters came. Are you understanding the concept or not? Money raised from equity and debt will be utilized for 2 sources. Number 1? Not answering. Number 1? Number 2? Investment in fixed assets will be dealt by chapter called as. That's why the name of capital budgeting is investment decision. In the study mat, if you see, there is no chapter name called as capital budgeting. Funniest part is, if you open the capital budgeting chapter, everywhere they will use capital budgeting, but the heading is not capital budgeting. Or you understand the point or not? So, what is the name of the chapter? Investment decision. Again, tell me, what are the 3 sources of finance? Equity. In these 3 ways, you will first raise the capital. Take this capital and you will invest in assets. Clear or not, everyone? First, see the screen once. See the screen. First, take the money from. Start from beginning. First, take money from equity. Second, take money from preference. Third, take money from and use entire money in. Did you see the animation there clearly? Don't see me, that's why here nothing will be there. Everyone understood the concept clearly. So tell me, take money from. Take money from. Take money from. Use money for ching, assets. So what are the 2 assets? Fixed assets, current assets. This is the first basic idea of this particular chapter. Everyone understood the point? Now answer. Who is giving you money? Equity is giving the money. Second, who is giving money? Third, who is giving money? Now listen carefully. They are buying and selling. They are buying and selling. 1 second, I will tell you one thing. You bought something to sell. You bought something to sell. You bought and you sell to some other person. Now listen, you buy at a cost. Therefore, you will sell at a cost. You bought at 100. You sold at 150. Eventually, what profit you made? 50. That means I bought at how much? 100. Means how much capital went from my pocket? 100. That 100 should return back. More than 100 should come back. Therefore, I sold at 150. Making a gain of 50. That means no fool in the world will invest amount to get back that amount. I should get back that amount and more profit should come. Clear, everyone? Equity shareholders, debt holders, preference shareholders are buying and selling. Yes, they buy and sell money. Money carries a cost. That's called as interest and dividends. Selling of money is called as giving of money. Buying of money is called as a taking of money. Buying will have what? Cost or not, everyone? Buying have? Buying have? Who is buying in this particular case? Company is buying. For company, buying money will become what? Start from beginning again. Tell me. Company is taking money or giving money in all the 3 cases? Taking money means it is buying or selling? Buying money. When it is buying money, it has to have some cost or not? Yes, money is taken in the form of goods or capital? Has some cost or not? Yes, name of the chapter is cost of capital. For buying this money, there involve lot of cost inside. That cost is called as a cost of capital. Clear, everyone? Yes, tell me, I bought a product for 100, sold at 150. What is my cost? 100. Answer? 100. Because here what I am buying? A good I am buying. At how much? 100. Selling at? 150. Profit? 50. Now, money is a means to buy the good. Money you are buying. In the first case, goods case. Money is a means to buy the good. So here money is not sold. What is bought and sold? Goods are bought, goods are sold. For that money is a element. Clear, everyone? But in the capital financing, what you are buying? Money you are buying. Clear or not, everyone? Therefore, I will ask return in terms of money, not in rupees, but in percentages. That became cost of capital as a percentage. That's why interest we will tell in rupees are percentages. You should apply on the amount you have taken. Clear everyone? So listen carefully to the point. Buying and selling of a pen can happen. I can buy a pen at 100, sell at 120. Possible or not possible? Here what is bought and sold? Pen. Okay, pen. I bought an iPad for 1,50,000. I can sell that to some other person at 1,60,000. Example. Now I am buying the good and selling the good or not? Here goods are bought and sold. But in the financing case, what is bought? Money is bought. What is sold? Money is sold. Equity shareholders are selling money or buying money? They are selling their money. Clear or not? When I sell, I will sell for free of cost at some expected return. That is called as a return they expect. That is called as a return. That is called as a return they expect. So from this the chapter has started. Tell me what are the three sources of financing one more time. First one. Equity la two types. Number one. Equity share capital, reserves and surplus. Nothing is there in my face. Either you should see the screen or see here. Don't see me. In my face nothing is there. At least previously used to cover. I am seeing projector. That concept also not there. Either see there or see the TV. Nothing is there in my face. See there. Point number one. What are the three sources of finance? Equity, preference, debt. Equity are two types. Number one, equity share capital. Second one, resource and surplus. Second, preference share. In the two types, preference share, convertible preference share. Everyone tell me second one. Convertible preference. Third one is a debt. Third one is the debt. Debt is most important in this chapter. Debt la again three types are there. Number one, bonds, debentures, loans, deposits. It can be either long term or it can also be short term. Everyone understood my concept or not? This entire capital raised will be used to finance what and what? Fixed assets and current assets. Fixed assets will be dealt by capital budgeting. Current assets will be dealt by working capital management chapter. There we will tell the judgment whether the capital raised at a cost or not. Capital raised free of cost at cost. What is the name of this chapter? Means the capital was given by equity free of cost. Preference free of cost. Debentures free of cost. They are expecting something in return or not? Let's say they are expecting 15% in return. How much? 15% in return. So you are raising money from debt. At debt to equity combination you raise. Overall what is the cost? 15%. You raised 1 crore. You raised. Means 15% is the WACC. Overall all of them put together is asking how much? 15. Everyone repeat. How much I raised? How much all are expecting together? 15% of 1 crore. Answer. That means in capital budgeting what we are going to analyze, 1 crore capital was raised and invested in these fixed assets. That fixed asset should give minimum 1 crore 15 lakh and 1 rupee. Are you understanding the point or not? It should not give 1 crore. 1 crore I am not happy because I have to pay 15 lakhs on them. Tell me how much capital I raised? How much cost? Percent. Sound illa. How much? Next 15%. 1 crore on 15%. 15 lakh I have to pay na. I have to pay excess over capital. Totally how much I should pay? That means this 1 crore rupee whatever I raised will be successful money raised only if the fixed asset in which I have invested, if it gives me 1 crore 15 lakhs 1 rupee, from there I am 100% successful. Clear or not everyone? That analysis we will make in a chapter called as capital budgeting. Are you understanding the point or not? Like that, whether current assets are properly performing or not, we will see in a chapter called as working capital estimates. Tell the name. Not happy again? Now observe the two chapters names. What is the first chapter name? Capital budgeting. Second one, working capital estimate. Both are guaranteed. Estimates are budget, estimate, working capital estimate, estimate. Guaranteed? Uncertain? Means what I think and what happened, there may be a variability or not. That variability is analyzed in a chapter called as financial statements analysis, became ratios analysis. That means whether reality is far away from the expectation or they reached the expectation or not, we are going to analyze in a chapter called as financial statements analysis. That's how these chapters are made out. Clear, everyone? There is a meaning in the chapters included into the syllabus. Knowing that meaning, you have to understand and do the answers. Clear, everyone? So this much introduction is required first to start. So observe this. Fund giver gives money to whom? Company. They will be happy only if you are going to pay them return. Return to equity shares is called as KE. Return to the cost of equity. Return to preference is called as KP, cost of preference. Next, return to debt is called as KD, called as cost of debt. Everyone understood the point? KE means KP, KD, cost of debt. You may ask a question, sir, then CA it should be cost. They went on phonetic pronunciation. That is not cost of, that is cost of. Therefore, they made on the basis of the phonetic pronunciation, they made cost of capital. Therefore, they used K. There is no other meaning behind that. Clear or not, everyone? Case Academy. Kishore. Sir, okay, leave off. So listen. So that's why they will use the word. So tell me, cost of equity abbreviated as? Everyone. Everyone. Yes. Preference? Debt? All put together, KO. Overall cost of capital. Everyone understood the point? But we are going to analyze that in much more detail in the next sessions. I mean, today, everyone, we are going to analyze individually all the capitals. So what is the summary of this chapter? What we are going to do? First thing, obviously, listen, don't get excited. So first one, individually we will value debt, we will value preference, we will value equity, individually. First, KD concepts will complete, KP we will complete, KE we will complete. Later, next starts the KO, which is more complicated. Exam questions come from both. 4 marks question come from individual cost of capital. 8 marks question will come from overall cost of capital. Understood the point or not? Worst case scenario questions I have from CA final. Best questions on cost of capital from a chapter called as Portfolio Theories and Asset Pricing Models. So in the chapter, some fantastic gold type questions are there. So those questions are extracted actually by CA Institute from CFA Institute, USA. So from there they borrowed, from there I borrowed, from them you will borrow, but borrowing should have a cost. You should do the answer properly. That's a written on that question. Sorry. Shall we start? So the point is, copy down this. This you need not. Just you write down fund giver, company, give the money, expect something in return. That return for equity is called as a KE, preference is called as KP, debt is called as KD. Write down this. Write down, please. Financial needs and the sources of finance, balance sheet, liabilities and assets. Whenever you are filling the balance sheet, first fill the liabilities. Make that as a habit whenever you do the FM. First you need to fill the liabilities, later comes the assets. Because unless and until finance happen, you can't make investment. Completed the first part. So financial needs and the sources of finance. So fund giver and the company, returns will be given to all the three sources of financing. One is equity shares in the form of KE. Sir, always remember K, short K you need to write. Subscript you need to write EP and D. Subscript. Subscript means below. Okay, K, subscript P. Don't write along with K. K, subscript E, subscript P and subscript D. So returns are to be paid to all the funds. Equity shares KE, preference shares KP, that is KD. Completed. Shall we continue? No. Next. See here. Listen. See here. Types of capital finances. Types of capital finances. Please everyone, see the screen. There are totally 3 types of capital finances. Number 1, long term. Number 2, medium term. Number 3, short term. First one, long term. For what purposes they will use? Long term finances will be generally running between 5 years to 10 years. It will be used for financing of big plant and machinery, land, building, etc. Medium term, 3 years to 5 years. They will generally use it for publicity and advertisements. Sir, publicity expenditure, if you see, it is capital expenditure? No, it is not valid for 10 years. So today, if there is a thumbs up ad given by any celebrity, they will change that celebrity in another 2-3 years. Are you understanding the point or not? See, for example, previously, thumbs up used to be endorsed by Amitabh Bachchan. Amitabh Bachchan actually used to endorse Pepsi. So after that thumbs up he endorsed. Amitabh Bachchan first initially when Kaun Barega Crorepati started way back in 2000s, he used to endorse it, who is very popular celebrity throughout India. India recognized the celebrity. Therefore everywhere from Kanyakumari to Kashmir, everyone know about Amitabh Bachchan. Therefore, since he is a recognized person, they took him as an ambassador, endorsed the brand. Clear? Might be he is the only celebrity in the entire India, at least if not world, who endorsed one single brand for a long number of years. Contract for 600 crores. That's all. 10 years full thumbs up everywhere he used to carry. Are you understanding or not? Publicity and advertisements, companies will spend crores and crores of rupee only for short span of around 1 year, 1.5 years or 2 years. Example, I will tell you another. When celebrities will be taken for endorsements, etc., they will use huge amount of capital in order to put before the publicity and endorsement. Film stars will come. Okay, film stars will come. When Vijay Devarkonda is in a full peak form during Arjun Reddy and after that, he was endorsing the brand. Listen, please. After back-to-back utter flops, again they are taking back the endorsement. Now he is not promoting thumbs up. Okay? Listen. I am not asking him movie name. If really movie debate has to come, I will definitely win. Okay? No problem. So listen, please. I am not here to debate on movies. So the point is, when he started endorsing it, Arjun Reddy is a super hit in Telugu. Not a normal hit. It's almost a trend-setting type. Before and after type it made. Immediately endorsements came. Companies started writing assignments with him that you will be endorsing this brand, that brand, all brands he endorsed. Are you understanding or not? Back to back when flops come, they change the person now. That means maximum their advertisement might work for how many years? Max 2 years or 3 years advertisement expenditure will work. Are you understanding or not? A cement manufacturing company is there. Factory was constructed. It will be valid for 2 years, 3 years. It will be valid for 15, 20 years. That will be under the first type of financing. What is the first type? Long term. First type? Long term. Second type? Medium term. Mostly advertisements will come in that form. Are you understanding or not? Third type. What is the third type? Short term. Short term means I don't want the finance even for 3 to 5 years. I want either for 1 year or less than 1 year. These finances are called as bridge finances. What these are? Bridge finances, meaning everything we will understand later. So short term finance will be valid for 1 year more Less than 1 year. And 1 year they will rise. So this will be in the form of what? Please read. First one, stock. All those things will come under that. First long term capital budgeting chapter will take. Last short term will be taken by working capital chapter. In middle there is a publicity concept is there na, that will be taken by CA final. There is a chapter called as a free cash flow models. There we will analyze. That's why with that much confidence I am telling you how advertisements will be working. Advertisements and publicity, how they are going to impact the company, how the publicity expenditure will be made, how returns will come back. All these we will analyze in a separate chapter in final with a topic called as a free cash flow in a chapter called as corporate valuation. There you will learn about all these things. I repeat for one last time, entire concept. There are 3 types of financing. Number 1, don't see there sir, nothing to see. Common sense is required. Don't prove that you don't have. So please answer. What is the first type? Second type? Last type? Long-term financing you raised. You purchase chocolates and biscuits. What you will purchase? Plant and machinery, land and building. That means the longevity will be very big. Okay. And moreover, that will be for minimum how many years? I have written 5. And maximum? That is only estimate. It can also be 10, 15, 20. Metro project is there. Railway metro. It will be for 60, 70 years project. Capital expenditure will be 13,000 crores. Long term or short term? 1 year or 2 year? More than 15, 20 years. That's all. It's a classic idea. Flyovers will be constructed in the city or not? One flyover will be there for at least 30 years or not? That's all. Their project life is 30 years. Example I have written 510. That means from 5 years onwards, long term will start. Within 5, medium term. Within 1, short term. Everyone understood the logic clearly? In your syllabus, what are the 2 things that you have? Long term is there, short term is there. Long term is dealt by capital budgeting. Short term is dealt by working capital chapter. Are you understanding the concept or not? Whether you raise money by long term or short term, capital has a cost. That will be analyzed in this chapter. Listening everyone? That's why we are discussing here. And after that, 4 points I will tell. Let us consider those 4, understand, complete, and then we'll go to the next concept. What are the 3 sources of finance you already know? Equity. One small question for you. I will ask you one question, answer this. See, a foundation knowledge is more than enough to tell the answer. Okay. Accounts. You prepare sole proprietor company or sole proprietor business balance sheet and P&L or not? Balance sheet and P&L. Okay. Now imagine a situation like this. Invested capital of 1 lakh. Capital on the liability side 1 lakh. 1 year business he has to do or not? Answer here. He invested that in the assets. 1 lakh. Invested in assets. Assets were utilized. Utilized and generated cash flows. We call revenue, sales. Clear? How much raised? With 1 lakh I purchased. I purchased 2 things. Fixed assets and current assets. 50,000 rupees plant and machinery. 50,000 rupees raw material. Using this fixed asset, raw material went to finished product came. Out of it I took the money. Okay, I took the final finished product, sold in the market. Sales happened. Clear everyone? Double the profit. Double the profit. I made a sale of, say for example, I made a sale of around 3 lakh. Sale value is 3 lakh. Purchases cost is there, na? Salaries and other expenses will be there or not? All those leaving out, I left with 80,000 rupee profit after paying taxes to government. How much is left? Okay, na? Now answer my question clearly. How much I invested? Profit how much I got in the first year? P&L account you will show that. Now what you will do with that net profit in the balance sheet? Perfect. That's why reserves is also equity. Because that reserve came from the profit of equity shares. Who give money? Equity shareholders. Listening? You will invest or not? Profit will come or not? That profit also will be added to their capital. So one thing you need to understand, reserve is as good as capital. Therefore you add profits to capital. Are you understanding or not? Now listen. Equity have given money. Who have given money? Equity have given money. Okay? Debt have given money. Preference also have given money. Profit will come because of equity's money. Profit will come because of everyone's money. Because the plant and machinery what you are using to manufacture is purchased out of the funds given by all the three. Please be in this world again. Again listen. Plant and machinery whatever you use for sale, finished good. Current asset, fixed asset, finished good. Sugarcane machine, sugar I sold. Sugarcane is a current asset. Stock. Sugarcane machine is a sugar is a finished good. Best example to understand. I sold sugar at 200% profit. Okay. Now answer my question. To sell sugar, I will put hand. Sugar. Dang, sell. What you have to do? Two purchases you have to do. Number one, current asset. Number two, fixed asset. Current asset and fixed asset come and join together to give what? Finished product. That finished product I will sell sale will knock all the expenses and result in a profit or not? Now the question is that profit belongs to one person or three persons? Answer sir. Who are they? Equity. First you should tell debt, preference, equity. First. Now the question I have to ask is that profit whatever comes is the profit to the equity, debt, preference or all? Wrong. Only equity. Debt don't take profits, they take fixed interest. Though I make bumper profits, I give only fixed interest to you. Though I make bumper profit, I will pay only fixed preference dividend to you. Whatever profit comes, that is the profit only of the equity. Then you may ask, Yanna Pakshapatam? A question will arise or not? They are taking the risk. Who? Everyone loudly. Everyone is taking what? What risk? If loss comes also I have to bear. You will not bear any loss. Happily you take fixed interest every year. You are not bearing any risk. Risk is with us. If business fail, we couldn't sell. Even then you don't compromise the interest. You are the first person who stands at the entrance gate. My money. But we are not like that. We will take if it comes. We don't take if it don't come. Therefore tell me, who is taking the risk and reward? Who is taking only the reward? Debt or preference, anything, will take only reward. They don't take risk in the business. When you don't take risk, how you can expect a heavy reward? Therefore I will give you fixed interest. Clear? Sale profit, what will come? Sorry, sale purchase, what will come? From that expenses deducted, what will come? Use properly. Sale purchases, what will come? Carried forward. Gross profit. From that what will happen? Expenses you will deduct. What will be deducted? Expenses. What is the first expense? Salaries, all those okay, leave off. What is one of the expense? Interest. That means from that gross profit already we paid you what? Interest. Already we paid what? Preference dividend. Balance is what? That is only for equity. Are you understanding the point or not? So therefore, I should add it to what capital? All capitals are equity capital. That's why I have written there in the first chart, equity and reserves and surplus. You can see there in the first diagram, whatever you have drawn. The balance sheet. Equity means equity, share capital and reserves and surplus. Hope everyone understood the meaning behind that. Now answer. Last question before you write the notes. Debt will give money with expectation or without? What is the name of the expectation they make? Interest. Also called as a cost of debt. Preference shareholders will expect what? Will expect what? Preference dividend. Name for that expectation is cost of preference. Equity expect what? Dividend. Equity expect what? Dividend. So dividend is nothing but breaking the profit. One pizza divided among various people. One pizza is the profit. But everyone will get full pizza, na? No. For your share you will get one part. Like that we will give the parts of pizza. Same way. Whatever left after taking by the debt and preference, balance the pizza will be shared completely to whom? For all equally, as per the number of shares. Number of shares they hold. That's called as a dividend. Dividend is nothing but profit in small parts. Clear everyone? Profit in smaller parts is called as what? Dividend. Everyone understood the concept? So, equity will give money without expectation or with expectation. With expectation called as dividend. The name of that expectation is cost of equity. Last one, this is a new one you are going to learn. Cost of reserves. Reserves and surplus is the money belonging to whom? Then who the hell are you to misuse them? On that also we have right. Therefore, what KE is will be equal to KR. If I expect 16% on equity shares amount, I will expect 20 on reserves. Or I will expect 5 rupees on reserves. What I expect on my money mean both are my money or not? Yes, answer, yeah. Yes, equity means my money. Reserves are my money. When it is my money, I will expect my return only. If I expect 16%, KE and KR both will be 16. Yes, clear everyone? Yes, everyone? Yes, but not all the time. But not all the time. Why is what we are going to discuss in one of the learning objective. Impact of flotation cost. Have you seen one of the learning objective? Impact of flotation cost is there? Yes, there you will see why sometimes equity is more costly than reserves. Clear everyone? Yes, reason, don't ask now. Lot of time is there to learn about that. Lastly it will come. Flotation cost impact. Okay. So at that time we will see in general KE equal to or KR equal to both are same generally, but not all the times. Example, which questions will come? KE not equal to KRA he will give to make your life miserable. Okay, why he will give equal? Maybe 1 or 2 times he may give, but in exams in general KE not equal to KR, flotation cost involvement only will come, including the last attempt. Last attempt 8 marks question came. 8 marks question came from flotation cost. If he give me a chance also I will ask same question. Why I will ask equal to basis? I will make it more complicated. So therefore, they will not generally give KE equal to KR questions. General rule is KE equal to KR. But sometimes equal to KR. Why? Flotation cost will be there. Meaning of flotation cost, impact, why KR will be lesser than KE. All these things we will discuss in that particular area separately. Understood the logic or not, everyone? So please write down this. Second one. Types of capital finances. You have written the second one? No. So write down. Types of capital finances. This is generally debt finance. In the brackets I have written debt. Equity is perpetual, it don't have terms. Equity share is having what life? Perpetual means a timing and no timer. Then how can you bifurcate between long, short? And moreover, don't imagine that FM means everything numericals calculator will be there. Half book will be theory. Institute book you open once, half theory will be there. It will be a blend of both theory and practice. Both will be there. You write, I will tell one point, lesson and write down. You copy down. Financial management is the branch of which subject? Accounts. That's the most irrelevant subject in our entire curriculum, first point. So, listen, it is a branch of economics. Financial management is a branch of economics. That's why FM and economics for finance. It is a branch of economics. Sir, I will, another question I will ask you, write down and by the way, listen, no problem, multitasking you can do. Because again, I can't spend time to ask these questions. Accumulated losses will come on which side of balance sheet? And accumulated losses means continuous losses, yes or no? Yes, that is your asset. Then why you are writing on assets? Why you are writing on, what is an asset? What is an asset? Tell me first, what is an asset? Anything which generates a revenue earning to the company is a asset. Accumulated losses generates revenue. Then why you are writing? Yes, really. In accountancy, there are lot of assumptions. To balance balance sheet, he will go to any end. That's why if you see, Nobel Award is there for all subjects in the world except accountancy. Nobel Award is given for finance, not for accounts. Reasons are very clear, because accounts contain lot of estimates, assumptions. As a first point, fundamental accounting assumptions are there. On that basis, we prepare the books of accounts. Write down long term, medium term, and short term. First one completed types of capital finances. Nothing I dragged. Cost of debt, cost of preference, cost of equity, cost of reserves. Spelling COST, OF of equity, EQUITY. Okay, na, bro? So write down and answer. Who will expect fixed return? Debt and preference. Debt will expect on debt capital, preference will expect on share capital, but both are fixed commitments. We call interest for loan or debt, we call dividend in case of shares. Debt completed, debt, cost of debt. So write down first. Array, 1 second, I can't jump from there to there. 1 minute, I will go. Liability side, it's a short-term loan. Short-term loan. Chapter 6 Companies Act. Acceptance of deposits, it's a liability. Variable cost? No, irrelevant. Variable cost and floating cost are different. If they don't, yes, they have to. I will tell you, all the concepts will come. Cost of reserves. Yes, that will come in the chapter. Completed writing? So how many sources are totally analyzed here? 4. First one is a cost of debt. Next one, preference. Third, equity. And fourth one, reserves. In the same sequence, we are going to do the problems also. Whatever the sequence you saw now. First debt, next preference, next equity, next reserves. Lastly, overall cost of capital. Chapter over. Okay. Sir, see here once. Not yet completed. Last. Sir, I can't spend more time on this. Please copy from the others. Next one. See the next concept once. After that, the formula chapter will start. Problems will also begin. So please listen. See the screen. One page away from the first practical question. Cost of debt. Listen carefully. When I say cost of debt, debt represents the borrowings to the company. Why it is important and how it is going to impact, we will see separately. But basics let us understand. Please see the screen. Number one, debt is a borrowing to the company. Companies can borrow in various ways. They can borrow in the form of debentures. They can borrow in the form of deposits. They can borrow in the form of loans. They can borrow in the form of any kind of bonds, etc. Nature is not important. At the end, what you are doing, it's a borrowing. Any kind of borrowing will be made by a person free of cost at the cost. So listen please. So borrowing will be carrying some cost. The cost that a borrowing carries is called as a borrowing cost, also called as a cost of debt. It is represented by K subscript D. This is a point number one. Understood or not? Yes, listen carefully. Every debenture, example I am taking debenture, will have four different important ingredients. Last benches, everyone listening? Please listen carefully. There are four very important elements of a debt instrument. Number one, you can see there, face value. What is the first one? Face value is the first important one. Why face value is important? On that face value only I will pay you interest. Therefore, the second very important element is interest. Third one, till when you will pay me interest? Maturity. Okay, I gave you principal at the beginning or not? That principal you will put it in pocket. What you have to do? Give me back or not? That principal given back we call as redemption value. Everyone repeat, what is it? Redemption value. Okay, now answer my question clearly. What are the four very important elements of a debt? These are the four pillars of debt. Okay, first one, second one, third one, third one. These are the four elements. Redemption value, fourth one. Okay, so interest, sorry, first one, face value, interest, maturity, redemption. In a flow you have to read. First, face value. Okay, face value. Face value, on that I will pay interest. Next question, for how many years? Maturity. After last year, what you will get? Redemption value. Answer over. These are the four important elements. Clear, everyone? Yes, understood or not? One time tell me all the four elements. Number one? 1 second. Face value is a value which is useful for payment of interest. Simply, face value is called as a principal given. Redemption value is principal taken back. Principal given? Principal taken. Loan should have a term or not? Maturity. In the meanwhile, what you will pay? Interest. That's the instrument that's called as a debt. Everyone understood the concept clearly or not? See the screen once. That's all, sir. This is the introduction to KD. With this, we will start doing the problems in this regard from the study material directly. Clear, everyone? See the concept now. Face value. Please read. It is the denomination of the bond. Interest is calculated on face value. Next, interest. Bonds, though not always, but in most of the cases carry interest with it, called as coupon. Stop there. Sir, why sir bonds, though not always? That means no interest bonds also there are. Yesterday only I told you, zero coupon bonds. Repeat. Coupon means? Zero interest means? No interest. Issued at some amount, redeemed at some amount. In middle, no interest. Those are zero coupon bond. Interest or no interest? Huh? No interest. So, though not always, but most of the times, bonds will carry interest. Next, continue. The coupon can be annual or even semi-annual. Means I can pay either once in a year or 2 times in a year. Next, continue. Zero coupon bonds and deep discount bonds has no interest. Meaning I will tell when we come there. Next, bonds. Read. Bonds has a fixed maturity. This is so except in case of irredeemable bond. There is a concept called as what? Irredeemable bonds. Repeat. Irredeemable bonds. There is a concept called as a irredeemable bond. Name make very clear. Irredeemable means redeemable or not redeemable? Those are called as perpetual bonds. Those are called as perpetual bonds. Except in those cases, normally bonds are having a maturity. Last one. What is the last one? Please read. What is the redemption concept? Redemption value is called as repayment value. Continue. Value of redemption is determined by agreement. Yesterday one question of 5 rupees par. Sorry, 5 rupees premium. Last but one question in the yesterday's class. Their bonds are redeemed at par of 5% premium. At the time of issue, they will write in the agreement. You give me 100 rupee principal, we give you 105 principal back. So summarize and tell me what are the 4 elements of a debt instrument. 1 second, don't see. First, now tell me, what is the importance of face value? Interest will be calculated on that. Interest will be calculated on market value or face value? For that. Second one, it is a return on return on debt capital. We will pay interest. That return is called as a interest is also called as interest is called as. It should be paid always, huh? In case of zero coupon bonds, there are bonds without any interest. Understood the point up to here or not? Next issue, last point. Last but one, sorry, maturity. Every bond generally will have fixed life. That life is called as what? Except in case of irredeemable bonds. And what is the last one? Tell me, you have taken principal. You have to again repay. Repayment is called as a redemption. Clear or not, everyone? Other name for repayment is what? Redemption. When you redeem, at what value you should redeem will be decided by agreement. Don't tell par, don't tell discount, don't tell premium. It is decided by agreement. Everyone understood the concept clearly? Copy down. Last theory question also completed. have written the first 2 points. Why I am asking is second point, one point is there. Optimum mix of equity and debt ensures a leverage. Yes or no? Therefore, another 2 chapters came in syllabus. Optimum capital, whether equity, how much, debt, how much, decided by a chapter called as a capital structure. Leverages is dealt by a separate chapter called as leverages. So all are interlinked concept. One place like if you miss class, na, that's all. Remaining Govinda. So completed. So write down the below content. 4 branches: face value, interest, maturity, redemption value. Completed writing. First two completed. Face value and interest. So completed writing. Next. Up to here, completed writing. So the four elements of debt will be, one is the face value, second one is interest, third one is maturity, and fourth one redemption. With this, all the basics of this chapter, overall understanding of the instruments that we are going to cover, debt, preference, equity and reserves, meanings, logic, characteristics were completed. From now, the practical problems and illustrations will start. Clear everyone? Full in-depth analysis we will make on this particular formula, derivation, how the formula came, interpretation, everything we will see in the class. Up to here everyone had a full clarity, yeah? Yes, take a break and come, we'll start with the analysis. 4:20 we will start. So let's continue. In the first session, we completed the theoretical discussion of this particular chapter. Now we are going to start with the valuation concepts in this particular chapter, which are practical questions. Please settle down. Okay. So now we are going to make the valuation with regard to the cost of debt. The chapter name is cost of capital. There are four kinds of capital. Number one is the equity share capital. Number two is the preference share capital. Number three is the debt capital. Number four is the reserve capital. So four kinds of capitals are there for us to analyze. We need to analyze the cost of individual capitals first. Cost of debt, cost of preference, cost of equity, cost of reserves. Once we complete all these four independently, then we will be going into overall cost of capital calculation, which will be called as a weighted average cost of capital, WACC. Okay. So let us start doing the answers. Before that, please come to the study material. Gone? Not working? So, the name of the concept we are going to start, Cost of debt capital. What is the concept? Cost of debt capital. Listen carefully. What we are going to do in this particular area, there are 4 kinds of capital financing that are possible. Already we read the theory, we have written also. First one, in the sequence you have written the previous answer. Open your books here. The book you have written already. What is the first capital? Cost of debt. Second one. Number 3. Fourth one. Last one. Overall cost of capital. That you need not write there. But all the capitals if your company is having, then we will call it as what? Overall cost of capital. Individually, first if you know how to calculate KD, KP, KE, then easily you can calculate what? KO. So first you need to know how to calculate this. After that this. After that this. Or KR for that case. Lately we will now do the concept of KO. So to reach this place, you need to understand all these individually first. Because every question given in examination, including the last attempt 8 marks question on the cost of capital chapter, first you need to individually calculate 4 things. Clear everyone? If a 8 marks question is given on KO, he can test you on KD, he can test you on KP, he can test you on KE, he can test you on KR, he can test you on KO. One time he can test entire chapter. Therefore, ideally 4 marks questions will come from individual valuation, 6 marks and 8 marks question will come from overall valuation. Clear everyone? Overall valuation, 7 problems are there in the study material. Fantastic problems, 7 exam questions. So we will do those. When we can do all those? Individual questions already given in exam, if you are thorough enough with them, then you can do those. Clear everyone? Before that, let us start with a point. First one. I will show you an answer. Had we already completed or not, you should tell. Face value. Okay. Tax benefit, did I tell? No. Why? Reason is we are going to learn now the tax benefit impact. Okay. I will discuss that separately. So listen carefully. First point number 1. If I am asking you to write some theory in the notes, okay, that theory is there in your study material. Past exam question adi. Whatever you have written previously, that's a 3 marks past exam question. So therefore, I will not unnecessarily write in the book. Reason is very clear. 1 page will cost me 1000 rupees when it go for printing. So I don't want to waste my money unnecessarily by writing nonsense in the book. Did you understand the point or not? For color printing, 1 page will cost me 1 rupee. 1000 books is the order minimum. Means how much I have to invest? 1000 rupees I have to invest on 1 extra page I write. Why nonsense I will write unnecessarily? Do you understand my point or not? If I write 500 pages, only relevant things I will write. Why unnecessarily I will increase my cost? 10 pages if I nonsense I write, 10,000 rupees extra. Do you understand? So therefore, main thing I want to tell you is, if something is written in the notes, unless and until I feel that this is very much important, I don't write. Clear? So nonsense I will never write. If something is important from exam's point of view, I may make it more easy, that's all. But I will write in the notes. Theory, everything will come in the notes itself. So please listen. Anyway, that notes you will copy in the class. Okay? So listen. These points like face value, interest, maturity, redemption, had we already completed or not? Yes, tax shield, I will discuss separately in the first problem. Okay? In the importance of tax shield. So first we are going into cost of irredeemable debentures. Please come to the study material. 4.5.2 cost of irredeemable debentures. Cost of irredeemable debentures. Shall we continue? Yes, before we start, Listen, I have some points to tell. If I stand and teach, I have a control. Over the class, I can see everyone. By hook or crook, I will make you to listen. But when I sit, I may not see the last benches and certain other people. So therefore, ensure that you are listening. Clear, everyone? At the end, you have to write the exam, not me. So therefore, it is your headache. Listen carefully. If you want me to repeat 5 times, 10 times, I will repeat. But listen carefully. We are going to start with the first question officially from the study material. Till now, all are my illustrations to make you understand. Clear? Our target study material completely should be there in your notes. In a most meaningful format, not like them. They will give direct steps, direct answer, no analysis, no formula interpretation. Directly they will give answers. Let's make it more meaningful. And moreover, remember one thing. There is no book better than institute study material. Are you understanding the point or not? I will give you one small common sense answer. After this, we will start. If institute person who prepares the question paper, if he bring some third party book which is not ISM and give questions, institute is admitting that I am waste, which it will never do. Are you understanding or not? If institute takes some other, if Koushik Mukhesh have written a book, example, I don't. I follow study material only. Example, I have written some third party material on SFM. Okay? They took my book and preparing the question paper. Means, who is waste here? ISM is waste. Because my book is useless. His book is having good problem. They will not admit that at any cost. They will give questions only from ISM. They will twist the questions here and there. But questions come only from ISM. You take any question paper, name it. I will show you from where the questions have come in exam. Study material is having 368 questions. More than that, they will not ask. Are you understanding the point or not? All those questions will be there in your notes with the meaningful answers. Clear, everyone? After doing everything from the ISM, still if you have some time, then do third party materials. Before that, don't do overaction. First to do normal action you do. What is required for getting? If 60 marks it comes, the minimum target should be 50-55 in a practical paper. So target on that. Okay? After that you do whatever the third party materials, all those things you can take and you can do that later. Am I clear? So therefore, please listen carefully. We are starting with the concept. First, see here. Valuation of cost of debt. What do you mean by cost? Cost is always expressed in terms of percentage. I said so many times, whenever we say cost for capitals, we should not express in terms of rupee. We should express in terms of percentages. Listening, everyone? Numbers will manipulate, but not percentages. I told you the other day one example. I invested 500. I got 100 rupees profit. I invested 500. I got 100 rupee profit. I invested 100. I got 50 rupees profit. Who is better? If you see as a number, I got 100 profit, you got 50 profit. I will tell 100 profit is better. But 100 profit on what? 500 investment. But 50 profit is on 100 investment. Who is better? Second one is better. So numbers may not give always a correct information. But what will definitely do? That's all. Everyone understood the concept clearly? So therefore, this is the comparison. Comparison will be always made in terms of rupees or will be made in terms of percentages. Percentage is the main way of comparison. Up to here, everyone understood the point clearly? There are two types of bonds. Irredeemable bond, redeemable bond. Which will have life, which don't have life. Redeemable will have a maturity or no maturity? For what? Redeemable bonds will have maturity. That's why N will come. That's why N will come. What is N? Life. I told you so many times in the previous sessions. Don't understand that I am interrupting you in the middle of the discussion. If you forget time value of money, you are forgetting everything in FM. I mean to say that. Time value of money is a base for FM here. People will laugh at you if you don't know time value of money properly. Without time value of money, if you start FM, we will do the biggest mistake in life. Time value of money is a base for financial management as a subject. Don't forget the basics of time value of money. What is the importance of N? I told you that point very clearly. Yes. Asal most important concept in the entire TVMA is time. That time is counted in terms of N. Clear? That time can be days, the time can be months, the time can be years. Here years. Okay? Okay na? Yes, tell me, in this formula, could you see anywhere N? No. Answer. No. N means not NP la N. NP means net proceed. That's completely different. I'm talking only N, life N. No. Yes or no? No. Here did you see? Yes, that means whenever I say that a bond is what kind of bond? Redeemable kind of bond. Which kind of bond it is? Redeemable kind of bond. It will necessarily have a life. Okay? This will have a life. That's called as a redeemable bond. See here. If the bond is irredeemable, means with redemption, without redemption? Issued. When it will be redeemed? At the time of winding up. When company will wound up, do you know? Therefore, unknown period we call as a indefinite period. Unknown period is also called as indefinite period. Therefore, N will be there in the formula, will not be there. Will not be there in the formula. So, what is the formula? Please tell me. KD. Please explain me what do you mean by KD? Debt equal to I into 1 minus T divided by NP, means net proceeds, not net profit. NP means what? Net proceeds. Meaning we need to understand. Formula interpretation we should understand. Don't just mug up the formula. I into 1 minus T by NP. I into 1 minus T by NP. Don't mug up like that. There should be a logic something. Okay? See this. See the screen once. Now I am going to explain you with what logic they might have prepared this particular formula. We are calculating the cost of debt. Okay, see here. I will ask you questions, answer one by one. I made investment of rupees 100. Listening everyone? Yes, I made investment of rupees 100. This investment of rupees 100, I invested in a pen. I have sold this pen back at 120. Now I want everyone to answer, what is my return in percentage terms? One second. Let me elaborately write down. How much you realized? How much you realized? 120. How much you invested? 100. Whole divided by 100 into 100. So technically to understand, how much you got? 20 by 100. Which gives you how much percent? 20%. This can I write like this? Instead of telling this like, I will write it. Total realization. What is this? Total realization minus initial investment. Minus initial investment. Whole divided by initial investment into 100. Can I write like this or not? This is called as return on investment as a percentage, one of the formula in SFM. So tell me what it is. What is the formula? It is return on investment. So everyone participate. This one, sir, please see there. Point number 1. What is this? Now tell me in numbers form. I invested how much? 100. I received how much? 120 is your return. You didn't get a return of 120. You realized 120. How much you paid? How much you invested? 100. You got back how much? 120. Entire 120 is not your return. Your return is how much? 20 is only your return. Understood the point or not? Yes, 20 is your return. As a percentage, if I have to tell on how much investment that 20 has obtained. Some people are not listening. Come back again. Listen. How much you invested? 100. How much you realized? 120. How much is the return excess of your investment? 20. That 20 rupees came on the investment of how much? 100. Therefore 20 by 100. 20 by 100. I ask you one question. Fatafat answer this. TR minus II can be called as what? What is TR? Some people are not even understanding what is TR. God bless you. Listen again. What is TR? That's why I said listen carefully. What is TR? Total realization. II means what? Initial investment. Total realization minus initial investment. We call it as return. We call it as return. Divided by what? Initial remove investment. Realization minus investment. Realization is called as return. Divided by investment into 100 will give you return on investment. Are you understanding the point or not? Return on investment. So tell me simple formula now. What is the return on investment formula? Return divided by investment. As simple as that. Return divided by investment. Now you should answer my question. I am now talking about redeemable debenture first, irredeemable debenture. Redeemable, irredeemable. Irredeemable debenture we are first talking. Yes or no? Yes, sir. Instead of talking ROI, what is ROI? Return I am expecting from the product, pen. Now tell me, I gave money to the company in the form of debenture or not? Yes, I received debenture. I given money in the form of equity or debt? Answer. I gave this money free of cost or at a cost? At a company has to pay me that cost or not? Yes, here the problem start. Cost of capital means return expected by the debt holder. It's not interest cost. Interest is what company pay. Return is what debenture holder expect. Common sense I will tell you, listen carefully. You gave me money. Today you gave me. Ongoing interest rates in the market. Market here represents interest market, RBI rates. General rate of RBI today is 9%. How much percent? 9. You gave me loan. 1 lakh loan you have given. You are expecting an interest of 9. I am also giving you 9. Listening or not? Yes, market is having lot of inflation. Now USA is facing inflation. Huh? Like that worldwide inflation is affected. When inflation is rising, government has to take necessary steps or not. First thing they will do is they will increase interest rates. They will increase. Interest rates are increased. You should use your common sense. You gave me money when the interest rates in the market are at how much? 9%. Now I will pay you how much interest? 9. Market rate of interest went to 12 because of inflation. Now I will pay you 12%, same 9%. You are happy or unhappy? Because what will be in your mind? Array, if I would have given that money today, I would have got a return of how much percent? Here you are expecting a return of 12, but I am giving only 9 to you. Same happens also with company. Cost of debt means return expected by debt holder, not interest paid by company. Return? Not satisfied. Return? Not the interest paid by company. Company will pay variable interest or fixed interest. But my expectation will be variable. Clear? KD equal to interest. Correct or wrong? KD equal to interest. Correct or wrong? Absolutely wrong. You need not even ask that question. KD equal to interest is a right statement or wrong statement? Pakka wrong statement. The first wrong you say in this class. KD means cost of debt, means cost to the company is the return what the shareholder expect. Technically, cost of debt can be understood as the return what a debt holder is expecting from the bonds or debentures. One last time I am asking one common answer you should tell. KD is return or interest? Variable or fixed? Variable or fixed? What is fixed? What is variable? Now we are calculating in this chapter returns are interest. My return is what I expect. Company has to pay what I expect. It may pay, may not pay. What happens is the rest of the story. You may ask a question, sir. As you given one example just now, inflation affected. RBI increased interest rate. 12% is a market rate. But company will pay 9 or 12. So what will happen because of that? Understood or not? How the stock markets are going to react is the next part of the chapter we are going to study. Clear everyone in the class? Yes, one last time you should answer me. Tell me what discussion we made now. Return on investment. Formula for return on investment? Return divided by investment. Not mugging up. Understood the logic or not? Yes, return on investment. I kept an investment of how much? 100. On that how much return you are getting? 20 rupees. Percentage terms it will be 20%. Understood the concept clearly or not? Yes, return, cost of capital, anything should be expressed in money terms or percentage terms. Next point. We are reading which concept in this particular chapter now? KD means what? First type of debt is redeemable debt, irredeemable debt. Irredeemable debt is a debt which is having life or no life. N will be there in the formula, will not be. Up to here everyone had clarity. Yes, now tell me. You invested 100 rupees. You invested 100 rupees in the debenture of TCS. TCS debentures you invested. How much you invested? 100. Now tell me. This company is paying a interest of 10% to you. Interest of 10% to you. Properly understand. I go very slow into the concept. Slowly answer. How much you receive? How much you invested? 100. In that company paid a interest of how much? 10%. Rupees how much? 10. Very good. You made an investment of how much? 100. Tell me return on investment for you now. Tell me, first you write denominator. How much you invested? 100. On that how much return you are getting? 10. As a percentage. 10%. Now only in this case, KD will be equal to the coupon rate. KD is equal to? When KD will be equal to interest? When the bond is trading at par. When the bond is trading at par. When the bond is trading at, when the bond is trading at, let's see the magic in numbers now. Tell me. I invested in the bond at 110. At how much? 110. Par value is 100. Market trading at, common sense again, if any. Market it is trading at how much rate? This is not the way. Hey, market it is trading at what rate? 110. Par value is how much? Par. Market value. Market value. If I have to buy today from the market, market value will apply to me, par value will apply. Market value will apply. Par value is the price at the beginning. Clear or not? Par value is the price at the time of issue. 2 years back this bond was issued at 100 rupees par value. Today it is traded at same 100, it raised price. It is now getting traded at how much price? Everyone. Now answer my question clearly. In the market it is getting traded at 110. But the par value is? Interest is paid on par value face value or on market value? Just now we read one theoretical question. Interest will be paid on par value, face value. Clear everyone? What is the face value? Interest rate is 10%. Now everyone tell me, today if you have to buy, you will buy at 100 or 110? Everyone? Tell me the return on investment as a percentage formula. First denominator what should be there? Investment or return? Everyone? Today if you have to buy, at what price you need to buy? At what price? 110. Okay, now how much interest company will pay? 100 rupees into 10% makes how much? 10. Tell me my return. 9.09. Sir, 9.09. This is KD. This is also called as YTM. Yield to maturity. Yield means return. Another word for return is called as yield. Coupon is called as cash flow. Interest is the cash flow. Yield is the return. These two words, bifurcation, you need to understand. What comes from my mouth now? Everything will be there in the book as a notes. You need not write anything. Every single point what come my mouth will be there in your book, in the whatever I have written. So please see the screen everyone. Summary of the entire discussion I will tell you once again for one last time, and then I will go for the question hour. Please listen carefully, start answering. Point number 1. Whenever bonds are there are two types of bonds. One is redeemable, another one is irredeemable. Redeemable bonds have life, irredeemable bonds don't have a life. Okay, so first point, cost of debt means minimum return shareholders or debt holders are expecting is called as a cost of capital. Cost of capital chapter targets on return, targets on interest. Everyone? Yield concentration, cash flow concentration, yield concentration. What is the yield expected? Clear everyone? Now you should answer. What do you mean by return on investment? What do you mean by return on investment? Return which a person gets out of his investment. What is the formula? Return divided by investment is equal to return on investment. It will be in rupee terms of percentages. Everyone understood the concept clearly? Next issue after this. Now, I am purchasing a bond. You should tell me the third answer now. Market price per share 90, par 100, coupon 10%. I want KD or I want return on investment. Tell me, what is the return on investment for me? No. First problems na tell slowly. Denominator la what should come? That means I want to ask you one question. You will market la what is the trading price? Market la what is trading price? Then you will pay 100 and buy a. When you are buying from the market, you should buy at which price? Market price. Par value is applicable if you buy directly from the company when they issue the debentures for the first time. You are purchasing from the company or purchasing from the market? Okay. Now tell me, fish market la which prices are traded? Market price. Bro, just don't answer the questions for answering sake. Listen, fish market la which prices are traded? Fish prices. Vegetable market la vegetable prices. Market la market prices. Are you understanding or not? Fish market la fish prices. Vegetable market la vegetable prices. Market la market prices. You are buying from company or you are buying from market? Then which prices should be there? Market price. Market price is how much? When market price is 90, who will sell you at 100 and which fool will buy at 100? When the market is traded at 90, tell me, your investment will be 100 or your investment will be 90? 90. Therefore, investment is 90. Company will pay return on 90, interest on 90, interest on 100. 100. So, 100 into 10% will be 10. Tell me percentage. 11.11. Now tell me, this is return on investment, also called as KD. Also called as KD. Okay. Now, YTM. How many cases we analyzed totally now? 3. Listen carefully, you should answer me. Then you can copy down. Please listen carefully. First case. Okay. So bond market price is 100 par. Bond market price is 110 traded at premium. Bond is quoted at 90, which is traded at discount. Interest 10%, 10%, 10%. YTM or KD or return, anything you call, or simply yield. You put any name. Tell me, how much in the first case? 10%. How much in the second case? 0.9%. 11.11%. This is a summary of entire information. Yes or no? Yes, now listen carefully to the concept. Now the real story starts. Listen. The numbers are there with us. Now we can do any magics on numbers. Number are not there means I can't tell from sky. See the screen properly. Point number 1. Market price 100, interest 100, YTM 100. Sorry, the interest 10%, YTM also 10%. Like this, let us understand. First situation you take. Situation number 1. How much you are expecting? Reverse you go. Reverse from the down to top. How much you are expecting? How much you are expecting? How much company is giving? You are happier, unhappier? Neutral. Therefore, share also traded at neutral price of par. Not listening. Yes, that's what I said. So tell me, you purchase, how much you are expecting? How much company is paying? Did you get any extra happiness? Did you get any extra sadness? You are neutral. Share also traded on, a bond also traded at a neutral price of par. How much par? Second situation. How much you are expecting? How much you are expecting? How much company is giving? Happier, unhappier? market is optimistic or pessimistic? Then bullish market will start. Means people are expecting only 9. Listening? But the company is paying how much? 10. A bull trend will start in the market which pushes the prices up. Price went to 110. Are you understanding the point or not? Third situation. How much you are expecting? Because RBI has raised the rates of interest because of inflation. If I would have invested somewhere today, I would have got 11.11%. But you are paying me the same 10%. I am happy or unhappy? Unhappy starts pessimistic market or optimism? Then the prices will pull down. It's called as a bearish trend will start in the market. Prices will start falling. Price came to 90. This is a point behind this concept of valuation. Everyone understood the point clearly or not? So the rates of interest will always operate on prices. But the problem is we should not analyze this way for this chapter. Because we are not seeing valuation chapter now. We are seeing cost of capital. Start from the top down approach now. Are you understanding or not? First case. How much you invested? What interest you are getting? What is the return on your investment? 10%. How much, sir? 10. Second case. How much you are investing? How much, sir? But the company will pay interest on 110, interest on 100. Because of which your 10 rupees literally got wasted. Therefore, yield will fall to 9.09. Did you understand the point or not? Third case you take now. How much you put money? Though you put 90 rupees, interest is paid on 100. On 10 rupees which you didn't invest, you are getting an income. It raised to 11. This is other way around. You can analyze this. Everyone understood the concept clearly or not? In the second case, you didn't get the money for what you invested. In the third case, you got money for what you didn't invest. Listening? Understood the concept? Now conclusions, let us draw. So up to here, everyone understood the point clearly? This is the meaning. Next, see here. 9.09 to 11.11. Please elaborate for me. Patiently answer this. I call this return. Yes or no? Or I call this as KD. Return on investment. Means what? Return divided by investment. Okay. Now, investment means par value net proceeds from you. Net proceeds. Your net proceeds means net purchase. You purchase at par value, market price. One question. Par or market? Sometimes market may be traded at par, but you buy only from market. Clear? Now tell me. Investment can also be understood as net purchase price or not? I will write NP. I will write what's a NP. Now tell me. Return. What is the next one? Return. Return you calculate in the percentage terms, but what company will pay you as a return? Company will pay you what? The cash flow. What you get from the company is what? Answer, yeah? Interest. Interest is a income to us, yes or no? That income is subjected to tax under income from other sources. DT started? You know 5 heads of income? What is the 5th head? Other sources. Other sources, do you know what incomes will come for tax? Whichever doesn't fall under any of the 4 will come. It is not a salary. It is not a house property. It is not business or profession. It is not capital gain. Anything comes under any of these 4, okay. Anything which you could not allocate a head automatically comes under a residuary category called as income from other sources. Are you understanding the concept or not? So therefore that comes under income from other sources. In that income from other sources, interest will come. Interest is not a salary. Interest is not house property. Interest is not business. Interest is not capital gain. Then where it should fall? Other sources. Listening or not? Interest is taxable or non-taxable? First tell me that. That means another impact. If company pay me interest, that interest will completely come to me. It will be having a tax. 1 minus T. 1 minus T. What is 1 minus T? Say for example, tax is 30%. How to write this 1 minus T? 1 minus 0.30. Interest is 10 rupees. So tell me, in every 10 rupees interest, how much will be going in the form of tax? See the screens everyone. See the screens everyone. Tell me, how much interest company pay me? Not answering. How much interest company pay me? That 10 rupees free of tax are subjected to tax. How much tax bracket I am falling? Exam. He will give in the question. You need not assume anything. He will give 10 or 20 or 30 or 35 or 45 or 55 he will give. Let us assume for understanding sake 30%. Tell me, in every 1 rupee or in every 1 rupee, how much tax I need to pay? 0.3 paisa. Yes or no? Yes, sir. In 10, every 10 I will get into hands. In the form of tax, some amount will go. Some amount will go in the form of tax. Clear or not? Yes, 100 rupees is the par. Interest percentage is 10. 10% of 100 means how much? 10. This 10 entirely come to the hand or in the form of tax it will go? How much tax? 30%. 30% of 10? How much? In my hand I will have 10 3 7 So 7 divided by 100. How much it will become? 7%. That means company paid me how much? 10%. But what I left out? 7. This is because of interest. So interest is a adverse cash flow na favorable cash flow na for the investor. I repeat, interest will be adding advantage to investor, adding a disadvantage to investor. Disadvantage to investor because in every rupee of interest there will be a tax element inclusive. Clear everyone? Last question. Tell, we will see the institute material. Tell me what is the formula for return on investment? 10th time I am repeating, I counted. Okay? Tell me what is the formula? Return divided by investment into 100. Return divided by investment. Company will pay you the return in the form of what? How much is the par? 100. Into how much percent? 10%. This amount completely comes into hand tax deduction. How much? 100. At what rate you invested? 100. Into 100. So tell me, 10 into 100 into 10%, how much? 10 into how much? 0.7 divided by 100. Technically how much percent? 7%. Now tell me, just answer. Tell in theoretical words, 10 is what? No wrong answers I want to listen. 10 is what? 1 means 1. 1 don't have interpretation. O-N-E I have to write. Minus is minus. 0.3 can be written as what? Divided by, what is this? Net proceeds. This is called as return on investment, also called as. That's how this formula has been derived. Everyone understood the concept clearly? Nothing but, this formula is nothing but return on investment. Nothing great in that. Everyone understood the logic clearly or not? Yes, after that, next stage, we are going to analyze this formula. This formula will have more background than this. Logically, we need to understand what is this RV, what is that NP, y divided by N, y divided by 2, what is the meaning behind this. Everything we will analyze in very clearly. First one, irredeemable, understood or not? Yes, do one thing, copy down this first. After that, we will do one question from the study material. Okay. Completed writing? Everyone, completed irredeemable bonds. Redeemable bonds formula is only an approximate formula, it is not accurate. Reasons also I will tell you why. IRR based is more accurate. Trial and error model based, that will give you exact result. Meaning, logic, everything we will see at that time. Shall we continue? Oh. See the screen, everyone. See there. So the first one, we already came to know about this point. Irredeemable, redeemable, two types of bonds will be there. Yes or no? First, question number 1 in the study material, illustration 1. Open that. See here, I have clearly written here illustrations from Institute study material. Numbers are also as per the study mat only. Don't see the answer. First point, since in the study material they will give the answers below the question, eyes will generally go, so cover with a book or something else. Please don't see the answers. Okay, keep one thing in mind, if you see the answer you are a failure. Okay, don't see the answers. Do wrong, no problem, but don't copy the answers. You try. Okay, listen now, please. Okay, see here, sir, listen. If in this book, if the answers are visible, don't see. That's all. See there. 5 years ago, Sona Limited Sir, names will be weird in FM. So like this, if you shout, now every day we should shout it names instead of dealing with the concept. Please. Shall I continue? Yes, sir. Okay. 5 years ago, Sona Limited issued 12% irredeemable debentures at 103 at a 3 premium to their par value of 100. Current market price of these debentures is how much? 94. If the company pay a tax of how much percent? 35%. Calculate its current cost of debenture capital. Okay. First answer my question. You saw the question or not, everyone? Yes, tell me. Company want to know the cost of debenture. Company want to know the cost of debenture. How tax is a disadvantage to us? Tax is an advantage to the company. Reason I will tell you. Listen, interest is a income for your expenditure. Interest is a income. Investor. I am a company. Who I am? Who you are? Investor. Now tell me, investor, as an investor, interest and tax on interest is an advantage for you or disadvantage? Because interest is an income for your expenditure. It's an income. For me it is an expense. Clear, everyone? Always remember, under income tax, expenses will give tax saving, incomes will give you tax payment. Example I will tell you. What is the classic example that one can take? If you don't have tax, okay, if you don't have a tax payment, then everyone will be okay. But if the tax is there, as an investor you will feel sad because you are not getting interest, you are getting interest after tax. You are getting interest? Company will pay 10 rupees interest. The 10 rupee interest, whatever company paid, company will show it on income side or expense side. Use your common sense. Company paying interest to the investor. Investor, it is an income, no doubt. For the company, it is an income or expense. Expense we will pay tax. But it will help us to have a tax saving. I will show you one example. See the screen. There is a P&L account. Gross profit, please, I am listening, noise please. Gross profit 100. All expenses are there. 50. Along with that, interest is also there. 20. Now tell me, what is my net profit? Answer. 30. On this I have to pay 10% interest. Sorry, tax. How much I have to pay? Rupees 3. Up to here, understood or not? Yes, sir. Now, net profit is 50 or 30? 30. Net profit, if it is 50, means, if there is no interest cost, my net profit would have been how much? 50. 50 into 10%, how much I would have paid? 5. But I am now paying rupees 5 or rupees 3. That 2 rupee reduction happened, that saving of tax happened because of what? Therefore, interest gives tax saving. Interest gives what? Tax saving. Okay, interest income gives tax saving, interest expense will give tax saving. Expense will give tax saving. Did you understand the explanation given here or not? Yes, I will ask you a question, answer. What is my profit? Gross profit? 100. All other expenses? 50. Say I don't have interest. I don't have interest. How much tax? 50 into how much percent? 10%. How much? 5. I have interest. How much interest? 20 rupees. Because of which my profit became? 30. On that, how much I will pay? 10%. That means how many rupees? 3 rupees. Actually, if the interest is not there, I would have paid on? I would have paid on. 3. Now I am paying on. 30. I would have paid a tax of. 5. Now I am paying a tax of. 3. How much a tax saving came? 2. That tax saving came because of any reason, because of interest. Therefore, interest gives tax saving. Understood or not, everyone? Yes, interest is a tax saving for investor or company. It is a tax danger for whom? Investor. Investor is happy with interest or unhappy? Companies will be very happy because it will give them a tax expenditure. First point, everyone understood or not? Yes, sir. Therefore, this chapter we will be given mixed questions. Sometimes they will ask us to analyze from investor point of view. Sometimes they will ask us to analyze from company point of view. You have to observe the question. Now everyone see my face or see somewhere else. See there. See wall clock. I will ask you question, answer. This question is asked from investor point of view or company. Doubt is coming now, everyone, because you didn't read the question. Shut your mouth and read the question first. So you have to do this from whose point of view? Yes, this is asked from whose point of view? Company point of view they asked this question. They didn't ask from investor. Some questions will be given from investor point of view. Then tax answer will be same. But interpretation will change. Their tax, here tax is a tax shield, tax payment. Tax shield has come. Instead of 5 I am paying 3. I got a saving of 2. Therefore, investor, if you have to interpret the same, what you will tell? Tax payment is there. Are you understanding the point or not? Fantastic. This is the idea behind this concept. Hope everyone understood the concept clearly or not? Yes, now see there. So tell me, I will ask you one last question. See the study mat book and answer. Not answer, question. Tell me. KD is also called as a return on investment. Yes or no? Yes, what is the formula for return on investment? Return divided by investment. See the question and tell me. Investment is how much? 100, 103, 94? 94. Huh? 94. Why not 103? 103 is the price at the 5 years ago. We want market price, we want current market price. When I am going to purchase, what is the price? 94. For my 94 investment, how much return it is going to give? 12%. 12% on how much? 100. So tell me how to answer roughly. I will calculate here for you. Everyone tell me. 100 into 12%. This is a completely expense saving. Saving. How much saving? 1 minus 0.35 whole divided by how much I invested? 94. So 12 into 0.65 divided by 94. Please tell me how much it is? 8.29%. Everyone understood how to do or not? So this is the answer. You need not write the question. First write down question number 1. Given information you write as a summary. First see the answer. See the answer once. Required to calculate the cost of debt. KD irredeemable. I into 1 minus T by NP. Where I equal to interest. T NP. I into 1 minus T. Analyze. Analysis. Please read. Analysis. Please read. 103 is given, but it is not used in the formula. Why? The reason is rupees 103 is the issue price 5 years ago, and it is not prevailing today. Today, if any investor want to invest, he has to do so at 94. So his investment will be 94. The formula, if one observe, is return on investment formula. ROI percent is return by investment. Return by investment. So what is the return given? Interest. Net profit. 12 is what? Interest. 94 is? This is what? Return on investment. How much is the return on investment? 12.77. Because of tax, it became 8.3. This is another way of calculating. Are you understanding the point or not? You can also do like this. Return on investment is 12.77 with the tax or without tax? Without tax. If you implement tax, it became 8.3 over. Clear or not, everyone? Two ways of doing the same. Like this you can do. Like this also you can do. Though the real ROI is 12.77 to the investor, tax impact has eroded the value of return on investment. Okay. That is an advantage to company. That is a disadvantage to the investor. Everyone understood the point clearly? Yes, please copy down. Illustration number 1. Question also not written. Okay, copy down. Completed? Up to here, I mean analysis why? Up to there. What you are writing here? And what is answer? Huh? Write it fast. Completed writing? Write down fast, very slow. Make it more fast. So completed writing, everyone? Okay, next one. Keep the heading. So last one is only for your understanding sake. From the investor point of view, I have written that. Okay, from investor point of view, if you see, really his return is 12.77. Okay, but that was reduced to 8.3 because of what? Tax. So tax is always a disadvantage to the investor, fantastic advantage to the companies. Shall we continue? Next one. Keep the heading valuation of redeemable bond. Sorry, valuation of cost of redeemable bond. Valuation of, I will also write along with you, write down. Valuation of cost of a redeemable bond. Valuation of cost of a redeemable bond. Okay. Now, please see here. Next question you take, question number 2, illustration 2. With that illustration, I will explain you the concept of redeemable bond and the formula also. Okay, let us see. Read the question, everyone. You need not see the screen. Everyone have the books with you. Please don't see the answer. First, let us read the question. Shall we begin? Okay. Let's do together. Let us read. Start. What is the question? Read. A company issued 10,000 10% debentures of rupees 100 each at a premium of 10% on win 1/4/27 to be matured on 1/4/22. The debentures will be redeemed on maturity. Therefore, it is a redeemable bond, irredeemable. Life or no life? N or no N? N is how many years? 5. 2017 to 18, 19, 20, 21, 22. How many years? 5. So, N equal to 5. Okay. Compute the cost of debentures assuming 35% as the tax rate. Company want to know what will be the effective cost of debt capital. So first point, answer my question clearly. This is a redeemable bond, irredeemable bond. What is the formula for irredeemable bond? I into 1 minus T whole divided by NP. Can I use the formula here? Because there is a life. There is a life. So we need to understand. You see my notes once. First what I have done is I have given the information, I have done the answer. Okay, I have done the answer first. Later, I have taken another question. Question number 3. In this question what I have done is I have done, later I analyzed. Why above formula is only an approximate? Question 1. YTM analysis. Everything I have done. That's the analysis on question number 3. Second question what we will do is just apply the formula and get the answer. Logics and answers behind it we will see in question number 3. Okay. So first let me say you the formula. See here. What is the formula for irredeemable bond? That is same even here. Tell me. I into T. But don't write NP directly. Plus RV minus NP whole divided by N whole divided by RV plus NP by 2. What is I? Everyone. What is a T? What is RV? Redemption value. See the question and tell what is the redemption value. Redeemed on maturity, he said. That's all. Did he say that redemption will be made at premium? He said that issue of the debentures is made at a premium. Did he said that redemption also will be at premium? Always remember, whenever nothing is said, RV is at 100. That's why see here, in the given question, read, the bond is redeemable, which means it has a fixed life. There are Two assumptions. Assumption number 1. RV is at 100. Purchase is made at issue time only. At what price company issued? 100. There are only two numbers. If not 100, next one will be 110. Observation here. Bad observation. Tell me, company issued at the beginning in the year 2017 at what price? Tell me, we are doing the question or not? That means you have to believe that we are in 2017 or 2022. Huh? Start from the beginning. Read the question again. Sir, one second. If you are, one second. If you are smiling or laughing at this bad performance now, you are going on a wrong track. When you are giving a wrong answer, even if the question was read so many times, you are having some problem. Okay? Check where you are going wrong. It's not a time to laugh or feel proud for the wrong answers. After all, you could not answer what is the redemption value means, you are in a bad situation. Please read the question again. Read the question once. Company issued how many bonds? What is the interest rate? What is the par? What is the issue price? Redemption given or not given? Assumed it. Assumed it. Par. How much is the par? 100. Listening. Issue is made at. Issue is made at. NP equal to 100. NP equal to 110. That's the point. Point number 1. Understood? Market price given or not given? Given or not given? I am purchasing on which date? 2017 or 2022? 2017 I am buying at the time of issue itself. Clear or not, everyone? Yes, for example, if I assume that I am buying somewhere in the middle, 2019, 2020, there should be some market price or not? Yes, he didn't give anything in the question. What does it mean? He wants us to assume that bond is purchased at the time of its issue. Understood the concept or not? Yes, this is the important point you need to observe. Please tell me, we will put numbers and write the answer. You don't write the answer. First, help me with the answer and the numbers. First, everyone in the class participate and tell me what is the formula. KD redeemable equal to, tell me, I into 1 minus T plus RV minus NP by, N whole divided by RV plus NP by 2. Logic of the formula, everything I will tell you, but just give me some time. Let us do the answer first. I. First tell me what is the par. Par. Into percentage. 10 or 12? Previous problem 12? Okay, 10%. Tax there or not there? How much? 1 minus 0.35 plus. Nothing is said. Redemption will be at. Redemption will be at par. Minus. At what price you purchased? Answer. Whole divided by 5. Whole divided by 100 plus 110 whole divided by 2. Please tell me. Numerator, first part you should tell me. 100 into 10% means 10. 10 into 0.65 means 6.5 plus 10 minus 10. Everyone. Minus 10. Okay. Just a minute. So minus how much? 2 divided by, tell me. 210 by 2, how much? Into 100. So tell me, 6.5 minus 2 means 4.5 whole divided by 105 into 100. 286 or approximated to 4.29%. Everyone understood or not? Yes, this is a calculation of cost of redeemable or irredeemable. With how much number of years life? Let us see whether we are correct or not. 4.28. 28 or 289, anything is okay, no problem. Understood the logic clearly or not, everyone? Okay, this is the way in which we need to do A better way of presentation would be like this. Please copy down. Question number 2. You need not even copy the question directly. Put the formula, do the answer. Fast, fast. I can't wait for more number of time. It's now 5:52. Exactly 5:55. I will go to the next one. Copy down very fast. Like this, if you present in exam, they will give you marks, or else forget about everything. Completed writing formula. Start doing the answer. Maximum possible do on your own. Nothing great in this question you can do. Completed writing. Up to 4.29 over. Don't copy the notes also. So in the given question, bond is redeemable, which means it has a fixed life. There are two assumptions in this question. RV is at 100. In the brackets you can write par. RV is at 100. So purchase is made at issue time only. Completed? Okay, done. Next question. Everyone completed writing? Can you go to the next one? Okay. See here, we have now completed another question on doing the YTM. A YTM, or we can call it as KD. Now listen carefully. I am going into the third question. Please see the screen or your notes at least. Don't see the answer, cover it. Observe the question properly. Company issued, are you with me everyone? Yes, question number 3. Company issued 10,000 10% debentures, 100 rupees par. So first, some information is already available. What is I? What is I? What is a par? Very good. Issued on 1/4/12, redeemable on 1/4/22. Means how many years of life? 10 years. Company wants to know the cost of its existing debt On 1/4/2017. So I am drawing here. Tell me, please. For this question, N is how many years? Wrong. 5 years only. That's the first point. Though it was issued way back in 2012, we are going to calculate the KD not on 2012. We are going to calculate on 2017. By the time we are going to calculate, tell me what is the value of asset? Present value of? How many number of times I have to repeat? What is the value of any asset? Present value of? Then when you have discounted required rate. Okay, present value of? When you are in 2017, we are valuing. Why 2012 will be valid for you? It's a past cash flow. Asset value will be present value of future cash flows. Then you should take only future. For 2017, future will be 18, 19, 20, 21, 22. That's how we need to understand it. Everyone understood the logic clearly or not? So tell me, value issue was made in the which year? 2012. Redeemable in which year? How many years life? I want to calculate the debt cost in which year? Sorry, 2017. Means I want one answer from you. We are going to value after 1 year, 2 year, 3 year, 4 year, 5 years. So the balance life is how many years? 5. So N will be 5 years. Remaining everything remains the same. Now tell me, 2017 when I am valuing, market price is trading at what? 80. See the question and tell. 80. NP will be 100 or 80. 80. Shall we do this answer together, everyone? Yes, keep the heading. Calculation of value of, calculation of cost of redeemable bond. Calculation of cost of redeemable bond. I will also do along with you. Help me with the numbers. Calculation of cost of redeemable bond. I will also do with you. Please help me with the numbers. Tell me what is the formula? KD equal to I into 1 minus T plus RV minus NP by N whole divided by RV plus NP by 2. Do along with my, don't give even a half minute time beyond this. Please do along with me. What is the I given in the question? First tell me what is the par? Into tax 30 or 35? 1 minus 0.35 plus what is the redemption value? Is there anything said in the question about redemption? Nothing is said. Redemption will be at par 100 minus, if I have to buy today, I should buy at what price? 80 divided by how many years of balance life? 5 whole divided by what is the RV? 100 by 80 divided by 100 plus 80 divided by 2. First point, everyone up to here completed writing? Yes, now answer to this question. 10 into 0.65 6.5 plus 20 by 4 20 by 5 4 plus rupees 4. Here it is plus or minus plus whole divided by 90 into 100. Please tell me percentage value. 11.67 11.67 11.67. Completed, everyone? Now see 11.67. Let us see the study material also. What is the answer? Exact 11.67. First point, everyone understood the doing up to here or not, everyone? Yes, 11.67 is the answer. Had everyone got the answer or not? Yes, logic of the formula. Now today I am not going to make you to write this. See here, because notes start here. All these you need to write it up to here. So I am not expecting this to happen today. But I am expecting the explanation to complete. See here, 15 minutes explanation I will give. Again I will repeat this in the tomorrow's session. Summary I will repeat. So please listen carefully. The main point behind this is understanding the formula properly. See here. First, there is a formula which says, you can see the second formula here. What is the formula here? Please read. I into 1 minus T by N RV plus NP by 2. This is a approximate formula. This is not what I said. Everywhere you see that will only be given. See here. Institute also has given a concept called as what? Yield to maturity. Yield to maturity. This is only an approximate formula. Which formula is a approximate? This is the one. What study material has given? Approximation. Sir, why sir this is an approximate? A question will arise or not? See the book. Your answer book. Your answer book. For the question that we have done just now. 11.67 something we got now. Open your notes. See here. What is the answer that we got? 11.67. Logic of the formula let us discuss once. Point number 1. I into 1 minus T whole divided by, I into 1 minus T plus RV minus NP by divided by will give the formula for KD or YTM, whatever you call. Yes or no? Yes, here starts the whole problem. Why it is an approximate? Question number 1. Approximate because you have taken denominator average price. Actually, my investment, what is the formula for return on investment? Return divided by investment. Return divided by investment. Listen carefully, all of you in the class. Main concept here, just for the reason that last 10 minutes I will tell some nonsense, please don't think. Last minute I close also will have some meaning. So please listen carefully. Okay. Point number 1. If you observe the formula clearly, previous formula I into 1 minus T by NP, answer over. Their approximation problem will not come. Anything what we calculate is exact and accurate. Problem with this is, tell me what is the formula for return on investment? Return by investment. Return by? Return by? Previous question. Previous question means first irredeemable. What is the return? Interest. What is the return? Interest. After tax you will take I into 1 minus T by investment is how much? NP. Investment is how much? But here in the denominator you have taken NP, RV plus NP by 2. Means you are taking, one second, means you are taking NP, average price. When you take average price, answer you get will be a average answer, accurate answer. First, because of that reason, it becomes an average, approximated. You may ask a question now, why to do like that, sir? Unnecessarily nonsense. They could have directly used the NP. Question will arise or not? Yes, they could have directly used the NP or not? Yes, why to add RV plus NP by 2? Why to make it average? Why to make it approximate? Is the fun or what? A question may arise. First point. CA inter student who started FM 3 days back, if he get this doubt, do you think that the person who made this model wouldn't have got the doubt? We sitting at West Mambalam got this doubt. He has done that from USA. Okay, these all financial models are made in United States. Some economists, they have drafted all this. Do you think that they don't get this doubt? Obviously they got. That means there should be something inside this formula which is making something approximate. And intentionally why they will make approximate? Question should arise. Problem comes all the way here. It is a redeemable bond, not irredeemable. Tell me, what is the return that a debenture will give? What is the return the debenture will give? Everyone. Interest is a return debenture will give. Yes or no? Like this, you should not think. If it is a redeemable bond, it gives interest and capital gain. Tell me, see the question, that's why I said, see your answer book. Tell me, at what price you purchased? Not answering. At what price you purchased? At what price you purchased? Again you are selling to the company. That means redemption is a selling. You purchased debenture at. Be here. You purchased debenture at. 5 years after you are selling it. You bought it. You sold it. You are getting a capital gain. Are you understanding the point or not? That means when the bond is redeemable, you are getting two returns, not one. Return number one, interest. Return number two, capital gain. Previous example, capital loss. See the previous example. Institute is not a mad fellow. They have given two questions, that's why. One on capital loss, another on capital gain. See, if you start doing the answers on formula answer, this is a problem. You will lose always. A concept will be gone. So understood the logic behind the formula or not? Everyone? What is RV? Sale. What is NP? Purchase. Sale minus purchase? Profit. In tax language we call it as capital gain. You put a capital of NP. You will get a sale of RV. Sale minus purchase will be profit. Also called as gain. Which gain? Capital gain. Because from your capital you got that gain. It's called as what? Capital gain. This capital gain, now listen, you will purchase. First point up to here, everyone understood? Yes, really? Yes, sir. Returns are how many types in case of redeemable bond? Number one. Number one. Number two. Number one. Number two. Capital gain means difference between sale minus purchase. I purchase at what price? NP. I sell at what price? RV. In that, capital gain may come, capital loss may come. You should adjust both. Yes, listening? Yes, now tell me, RV is a redemption value. Yes or no? Yes, in this question, how much? 100. In this question, how much? 100. Now tell me, in this question, 100. Okay, now. In this question it is 100. You purchase, you are redeeming today na, after 5 years. After 5 years. Huh? After 5 years. NP is purchase price, yes or no? Yes. You are purchasing today na, after 5 years. Today. But you will redeem? After 5 years. I repeat once again. Purchase is made. Today. Redemption is made. After 5 years. Last one time. Purchase is made. Today. Redemption is made. After now answer my question clearly. Redemption is made after 5 years. Okay? Purchase is made today. Both belong to same time frame or different time frames. But formula is reducing the true cash flow streams which belongs to different time frames. Yes or no? Yes, that's why formula is approximate. It doesn't consider time value of money. Not reasons, not yet complete. Still there. Listen carefully. This is one among the reasons. Everyone understood or not? Yes, sir. Next question. There are two returns. First return, I into 1 minus, sorry, I, interest. First one? Interest. First one? Interest. To that you are adding what? Capital gain. In reality, you will get capital gain every year. You will get capital gain at the end. You are calculating annualized capital gain as if you got capital gain every year. See the formula here. See, don't see my face. RV. What? RV means what? NP means what? RV made every year at the end of fifth year. But your RV minus NP is a capital gain. You will get capital gain every year. You will get capital gain at the end of fifth year. But by dividing it by 5, you are calculating as if you are getting capital gain every year. Reason is you are adding that to the interest which is already per annum. So you are forced to convert capital gain into per annum terms. That's why formula became approximate. Are you understanding the concept clearly or not? I into 1 minus T is interest comes yearly, one time in fifth year. Capital gain will come one time. Capital gain will come one time. To one time cash flow which comes after 5 years, can I add a per annum cash flow? Na? Therefore I should convert what also into per annum? Capital gain also I should convert into per annum terms. Therefore they are forced to do that. Since in the numerator they have taken RV minus NP, for consistency in the formula they have taken average in denominator, which made the formula totally approximate. This is how that formula has been derived. Everyone understood the logic clearly or not? We will see the remaining in the next class. So very good afternoon. So in the previous class we started with the concept of YTM, yield to maturity, KD calculation. Formula also we came to know. So before going into that, the summary of the entire yesterday's discussion. First one, the value of any asset will be the present value of its future cash flows discounted at a required rate of return. So that's called as a value of an asset. So there are the elements like present value, future cash flows. Two elements are there. One is a present value, second one is future cash flows. That means the future cash flows must be brought into the present value. To do so, we require something to bring back. So that the time machine will be the PV factors. So PV factor will bring the future into present. So this is what we have seen. So after that, we came to know that there are two types of cash flows. One is a discounting and then one is a compounding. Discounting is a concept where the present cash flow, the future cash flows will be brought to present. And compounding is a concept of taking the present to future. Next one, there are four types of cash flow streams. One is single cash flow, second one is annuity cash flow, third one multiple uneven cash flows, and fourth one perpetual cash flows. About perpetual cash flows I didn't tell anything. We are going to discuss that in first and dividends chapter as well. First chapter summary I will discuss. Dividends chapter in-depth analysis, interpretation, derivation, concept, application. Everything we will see there, including torture last. Next, after that, the next concept we completed is understanding the time value of money and its importance. Okay, so there we came to know that the formula regarding the discounting and compounding, when it comes to discounting, PV equal to FV divided by 1 plus R whole power n. That is for the single cash flow. If it is a multiple uneven cash flow, formula will not be there. In a table you need to put the cash flows, apply PV factor, you will get the answer. Next, the third one, if you want to go for annuity cash flow, okay, 1 by R into 1 minus 1 by R whole power n plus 1 by R whole power n. That's a formula. Next, after that we came into perpetual. Perpetual I didn't discuss anything in detail. We are going to see in the another two chapters. Next issue. After that, then I gave you one illustration regarding whether investing 1 rupee in all the 3 years or whether to get inflow of small inflow consistently is better or a big inflow in future is better. Then we came to know that small returns in the individual years consistently if you get, there will be a pattern of reinvestment back. So for that reason, that will be good. So we understood the importance of reinvestment. So remaining concepts of reinvestment, how important the reinvestment in a company, we will understand in the chapter called as capital budgeting. Okay, there in-depth analysis we will make. Horrible questions are there from CA final. So those questions we are going to bring out. These are bacha questions, IPCC CA inter questions. This just like that after discussing in class you can do. Okay, if I guide properly first class learning, you can do the problems that are given in CA Inter. That is not our target. The worst case scenario questions came in CFA and CA final. So that I will show you how the questions can come. Decision tables, decision tree tables, okay, certainty equivalent concepts like that. Some horrible concepts are there in capital budgeting. So those we will see. I will import the questions directly from the CA final. So I will show you the study material of CA final and I will do from that directly. So you can understand the impact of worst case scenarios in capital budgeting, how they can ask, how bad question can come. Okay. So that's what we are going to see in capital budgeting. Capital budgeting is our classes USP. USP means unique selling proportion will be there. Na? If Koushik Mukhesh is a faculty, then your capital budgeting in CA Inter and the portfolio theories, asset pricing models, futures and options and foreign exchange in CA final. So those are the hardcore difficult concepts in CA Inter, that is in CA final. So let's target those first. Okay. So in that scenario, we started first with the cost of capital chapter. Every capital or every company in order to make investments has to first raise money in the form of three sources. Number one, equity. Number two, preference. Number three, debt. All the three monies, whatever are received, will be invested. From the investment, what will come? Returns will come. That's called as a return on investment. The return equity gives, the return debt gives, the return preference share also will give. Clear everyone? So simply to tell, the cash flows given by the shares is called as a dividend. Cash flows given by debenture is called as a interest. Cash flows given by preference share is called as a preference dividend. Clear? But we don't want your cash flow, we want our yield percentage. Yield is always dependent on net proceeds what I invested. Yield is not about face value, yield is about investment value. So therefore, companies will pay dividend on face value, interest on face value, preference dividend on face value. But I will make investment at face value, na? Answer. Today I want to purchase TCS share. TCS par value is 10 rupees. Market value 3,300 rupees. You will purchase at 3,300. You will purchase at 10 rupees. That's all. That means my investment will not be on face value. Though you pay dividend on face value. You will pay dividend on. But I will invest it. That means return on investment does not mean return by face value. It is written by market values. Clear or not everyone? On that basis we have calculated. So that's why first we went into the debt capital calculation, the cost of debt capital. Cost of capital can be understood from two angles. One from the company, another one from the investor. Maximum questions will be from the company point of view. Some questions can also come from the investor point of view. Both the cases of formula same, concept same, everything is same. Interpretation changes. If you take the question from the company point of view, everything is an expense. Interest is an expense for it. Yes or no? Interest is an expense. Tax is a tax saving. When it comes to investor point of view, interest is a income. Tax will become tax payment, not tax saving. Clear everyone? Now listen carefully. Companies will pay interest on face values or market values. Interest paid on market value and face value will be same or maybe different. Therefore, company wanted to know, I am paying on face value, no doubt. But in the market, what is an expectation? What my debenture holders are expecting can be understood if I take face values, if I take market prices. Therefore, company also will take market prices and calculate the KD. Repetition one more time. Listen. Why KD calculation is required for a company? A question will arise or not? Company, shall I continue? Listen. Why KD is important? A question will arise. I issued debentures in the year 2022, last year. Issued debentures in the year 2022, last year. I issued debentures on Jan 1st, 2022. Today, RBI announced the repo rate, 6.5%. Today morning, RBI announced reverse repo and repo rate to be settled at 6.5. Immediately, markets raised like anything. So, again there is a fall due to various other reasons. But the repo rate announcement, immediately, markets have raised by 36 points. So all of a sudden market gained. Again it falls due to some other reasons. But try to understand why KD has to be calculated by the company. Investor calculating KD means logic is there because he is investing at net proceeds. Are you understanding or not? But why companies has to calculate KD? Do you understand my point or not? Why? Why companies has to calculate KD? I will ask you one question, answer again. Company issued debenture at 100 rupees with an interest of 10%. Interest of? 10%. Market price will be par value at that time, 100. After that, par value will be same, market value will be same as par, it may change. 2 months after, 100 rupee debenture became 103 rupees. How much? How much? 103 is a market price of the debenture. Tell me, Koushik Mukhesh want to purchase after 2 months. At what price I have to buy? 100, 103. Tell me, denominator la return investment? Top? What is the return given by company? What is that? Interest. Yes or no? Tell me, how much interest? 10%. 10% of 100 rupee. Tell me, what is the numerator amount? What is the denominator amount? What is the KD? Some amount will come. 9.71. That is the interest return. That is the interest return. Now listen carefully to the point. Why companies will calculate it? If an investor calculate that, common sense is there. He want to know how much return he got. Yes or no? Why companies will calculate? Reason is, if they want to go for a debenture issue next, at that rate you have to issue the debentures. If you issue at 10%, they will take. For example, market is giving a KD of 9.1%. 9.1%. That means today market price of my company's debentures are 103. Clear? How much? 103. So for that 103, KD should not be 10%, it should be only 9.71%. If the company is going for an issue of debentures next after 2 months, interest will not be decided at 10, they will decide at 9.71. Did you now understand the point clearly or not? To match with the market, sometimes companies also will calculate the cost of debt. This is reason number 1. I repeat once again. Listen carefully. Whenever company, sir, investor, why he calculate KD? Why investor calculates KD? To know his return as a percentage. But why companies will calculate KD? If I calculate KD, I will get the interest rate, market interest rate. Market interest rate I will know. That means company is going to start a very big project in the month of September 2023. Clear? In the month of September 2023, company want to start a very big project. That project will be financed by equity and debt, both combination. Clear everyone? Now tell me, if it is financed only by equity, only by debt, both financed. When both finances are included, I should pay some interest on debentures or not? That interest rate will be decided as per the KD. Clear or not? When the ongoing market interest rate is at 9.4, 9.3 or 8.5, why I have to pay 10% to my shareholders, debenture holders? So to fix the rate, I want to know what is the ongoing cost. For that they will calculate the, that's all. Everyone understood the concept clearly or not? Okay, so this is the meaning. More about this we can understand when we do the problems. So first, tell me, there are 2 types of debentures. One is irredeemable. Another one is irredeemable bond will not have. Redeemable bond will have. N will be therein. N will be therein. N will not be therein. All calculations should be made on the basis of face value, NP. What is NP? What is NP? Net proceeds means It will be market, it will be par value, market value. NP is also called as market value. At the market price you have to buy. Clear everyone? This is another point we completed. Tell me now, irredeemable bond, what is the formula? KD equal to I into 1 minus T by NP. What is I? What is T? What is NP? It is nothing but what formula? Return on investment. What is the investment you made? NP. What is the return you got? Interest. That interest is completely with you or it is subjected to tax? Remove the tax element. Whatever left out will be after tax return. Clear everyone? Then we went into the next area called as a redeemable bond KD calculation. Tell me, redeemable bond KD calculation, the formula is KD equal to I into 1 minus T plus RV minus NP by N whole divided by RV plus NP by 2. Now tell me, logic of the formula also I told you in the last class very clearly. Okay. I into 1 minus T, what does it mean? Interest after tax. Everyone repeat what it is. Interest after tax plus capital gain, annualized capital gain. What do you mean annualized capital gain? Capital gain on per annum basis. Okay. Now tell me, that formula is accurate or approximate? Why it is approximate? Because I into 1 minus T. I. Tax remove the tax element. I. Interest will come every year, once in 5th year. RV means? Redeemable value, you will get inflow na outflow na? Use common sense. If your chipsets are very old, please change it with the latest M2 chip. Do you know what I mean to say? I ask a question, 5 seconds gap. Then brain will send signals. Redemption value. By that time I completed formula also. Update your chipsets properly. So listen again. Listen. The point is, whenever there is a KD calculation for a redeemable bond, tell me, what is I? Per annum 5th year. Tax, remove that. Okay. I don't want to discuss about taxation now. Tell me, RV means what? At the redemption will happen today, na? After 5 years. I am talking about that question, 5 years. Don't fix in mind that always 5. Okay, that problem is also there with you. Don't fix 5 years, then after that one student will stand. Sir, one small mistake in problem, sir. Why RV is more than 5? Example sake, I have taken 5 in that question. Okay, on that question I am asking the question now. Tell me, RV happens today, na? After 5 years, sir. At the redemption date, I will get inflow na outflow na? Inflow of interest, inflow of principal. Everyone? RV minus? What is NP? Can I call it as a purchase price? So RV minus purchase price, also called as sale minus purchases. It gives you what? Gain. Which gain? Capital gain divided by life. Then it gives you per annum capital gain. Why we have done per annum capital gain? Because interest you are adding that. Interest will come per annum. Therefore capital gain is also converted into per annum. Really you will get per annum capital gain. That's why formula is an approximate. This is what we have discussed, everyone. Moreover, in the denominator also we divided with the price, average price. That is only to maintain consistency. When in the numerator you are using RV minus NP, denominator also they have taken average price instead of taking actual price. Therefore, lastly, the formula whatever they use will give you accurate, approximate KD. But we want accurate. How to do is a question that we are going to answer now. This is the summary of the discussions made. Clear everyone in the class? Let us start. So, please come over to question number 3. We completed question 3. Up to where we completed? 11.67. Okay. See the screen once. See the screen once. YTM approach. KD is also called as a YTM. KD is also called as YTM. Please see the screen once. Please see the screen. YTM means yield to maturity. YTM's other name is called as KD. KD is also called as YTM, or YTM also called as a KD. Anything you can use in exam, no problem. This model considers IRR concept and thereby gives accurate KD as a percentage. First let us read. In principle, let us understand why above formula is an approximate. Okay. Don't sit silent, read. In the above formula, there are two approximate numbers, namely annualized capital gain or loss, average price of investment. So, numerator approximator, denominator approximator, both are approximate. Therefore, answer will automatically become a approximate answer. See that. Investment value is how much? Redemption? Read the below point. Investor who invested rupees 80 is sold back to the company at rupees 100, eventually making a gain of rupees 20 at the end of 5 years. But the formula uses average capital gain per annum as if it is uniformly earned throughout 5 years, which is not true. But formula can't escape having this because numerator to the formula is having two components. Number one, coupon. It is in which terms? Per annum. Capital gain or loss should be in per annum terms to add to the first part, which is already in per annum terms, to make it more accurate. IRR is used. What is that IRR concept? We will discuss once you write the notes. Okay. Read the numerator, denominator part. Since numerator has already considered RV and NP, to maintain uniformity, denominator considered average investment, making formula as an average estimate but not accurate. To make it accurate, we use IRR or YTM model. Up to here clear, everyone? Okay. Write down the notes. I think up to 11.67 you completed writing the notes, right? Okay. So copy down YTM approach. YTM approach. So make it fast. Don't write too slow. At least maintain an average speed. Complete it. This page completed? Left side? Right side? First branch? Annual annualized capital gain or loss. That also you didn't put? Yes, I know you would. So maybe you know or not, ICAI proposal of new syllabus is rejected by MCA. I kept a message in my group also. So proposal was rejected as expected. So no worry, you will continue under old scheme only. So new scheme announcement will come soon. Till the time, don't believe any rumors. No one know. Now also, when Central Council member shared the message over the Twitter that it successfully rejected ICAI. Stop talking, please write down. Started again. Now everyone will become ICAI council member. Write down. Write down, make it fast. Write down. Write down, please make it fast. So once you write this, numerical workings will start again. So let us start with analyzing it. Complete it fast. Arey, 1 minute. Why you get excited? Just 1 minute. Right now. Make it fast. Coupon is in per annum terms. Capital gain or loss should be in per annum terms to add to the first part, which is already in per annum terms. To make it more accurate, IRR is used. Completed, everyone? So let's continue. See here. So see here once. So now we have completed calculation, write in the notes with regard to reason why the formula is a approximate, but it is not a accurate number. Reason we came to know. Listening, everyone? So the reason why it is an approximate formula but not an accurate, we have known. And the clean reason behind that is, since the formula used will contain certain things which are abnormal assumptions, like capital gain to come every year, and analysis and some observations like taking average prices, making the formula more approximate than making it an accurate number. To make it accurate, what we need to do? We need to use a strategy called as IRR. IRR means internal rate of return. What is the name? Internal rate of return. Take the question. Take the question given in the study material. Take out the question. We want the numbers. Okay. See here. Please listen. So the point is, when you take this particular counts, have you taken the numbers? Please see the numbers once. Illustration number 3. See the book and tell me, what is the interest rate? 10%. What is the par value? Okay. Next, what is the market price at present? Now answer my question. You have calculated normal approximate formula calculating KD. Yes or no? Yes, sir. When you use the normal KD calculation, you are taking an average price in the denominator. Which price? Average price. Average price represents RV at 50%, NP at 50% you have taken, because you are dividing it by 2. A plus B by 2 equal to A by 2 plus B by 2. Same logic. You are taking half. Okay, 50% RV, 50% NP. This is a consideration that you have made. Are you understanding or not? Yes, so therefore the logic behind this is, see here. Whenever you are taking a price below, okay, you are taking an average price, but actually you purchased at what price? Net proceeds of 80 rupees. So the market price is 80. So listen carefully to the point. Whatever you got, 11.67% is a guaranteed accurate number, approximate. Everyone, we need to now convert that into accurate number using a concept called as IRR. How it will be done? Let me first do. I will show you how to do that analysis. Once after that you can start copying the notes. But please don't copy when the class is moving on. Please listen. Help me with the numbers. Okay. See here. Help me with the numbers. First. Year. Cash flow, PV at the rate of, tell me, how much you got now? How much percentage we have got now? 11.67% you got. 11.67 is accurate or approximate? Answer? Okay. 11.67 is a approximate. That means main answer will not be 11.67. It may be either more than 11.67, maybe less than 11.67. We need to consider 2 rates now. Trial and error method means, let us consider 10%. Let us consider PV, CF, PV at the rate of, let us consider 12%. Let's give a 2% gap. This 2% is also not any memory technique type. We have to do trial and error in exam also. That's why in the study mat also they will use the word trial and error. Clear everyone? You have to do it at 10. You will do it at 12. Do also at 14. At somewhere you will get the right answer. How right answer will come, I will show you. Clear everyone? Please see the screen. Before we start, answer one question. PV equal to FV divided by 1 plus R whole power N. What is PV? Present value of dash. Okay, future cash flow. Say, who is giving that future cash flow? God is not giving future cash flow. Who is giving? Asset will be giving the future cash flow. Yes or no? So the value of an asset is present value of future cash flows discounted at required rate of return. Yes or no, everyone? Yes, so this is nothing but the value of a asset. Here what is the asset under consideration in this chapter? In this chapter we are reading cost of capital. We are using debt capital. What is the asset here? Debenture is the asset. What is the asset? Debenture. What is the asset? Debenture. Because investor is investing in the debenture. For him it is a asset. Clear everyone? Yes, see the screen now. Why I am asking this you will understand in just in a while. But before going into that answer, PV equal to FV divided by 1 plus R whole power N. Nothing is there in my face. Please see the screen. Okay? Answer. Therefore, value of asset will increase with the increase in RA, decrease in RA. Did you understand what I asked? Yes, sir. This value will increase with the increase in RA, decrease in RA. Decrease in RA. Reason I told you. That's a clarity. So when the asset and required rate are having inverse proportion, with the fall in R, value will rise. Fall in R. Value will rise. How much R you got in the answer? 11.67. If I reduce it to 10, I am coming from 11 more than 11. I am coming less than 11. I am first taking which rate here? Use common sense and tell 10. Less than 11.67 or more than? Answer 11.67. Therefore, the answer you will get should be more than 80 rupees. Should be more than 80 rupees. Now I will take a 12 also. Definitely it will give a value less than 80 or more than 80. Less than 80. In middle it should be there. How to calculate that middle rate is a point here. Did you understand how IRR should be calculated or not? Yes, we will calculate directly using trial and error. Anyone, God also should do trial and error only. By seeing numbers no one can tell. That's why formula, though it is approximate, why it became popular, at least it is giving a nearest estimate. 11.67 is there, then what I will do? Okay, 11.61 means it may be somewhere either 9 or 10, 11, 12, 13 like that. Near and around I will know where it will be. If this formula is not there, I will start with 1% to 2%. Did you understand why formula became important or not, everyone? See the screen now. Tell me, year cash flow, PV at the rate of how much percent? 10%. PV CF. PV at the rate of 12%, PVCF. Everyone help me with the numbers. How many years is the life of this bond? First point number one, everyone don't sit idle, see the screen directly, put calculator. We are starting with numbers. Apply and tell me, how many years life? Same cash flow na, different cash flow na? For all the 5 years, I will get same cash flow na, different cash flow na? Same. It is single cash flow na, annuity cash flow na, multiple uneven cash flow na, perpetual cash flow na. So I will take 1, 2, 3, 4, 5, 1, 2, 5. Tell me how much? Interest. 100 into how much percent? Means how much rupee? 10 rupees. Okay, now 10% for 5 years, calculate annuity factor. That's why time value of money. Let everyone calculate. You tell the number 3.790 na? 791. 3 digits you need to close. I told you already. First tell me, how many of you could not calculate annuity number properly? If you are so, at least tell me, I will once again repeat how to calculate annuities. Unnecessarily for ego sake, if you don't tell now, entire SFMA blur. How many of you want me to repeat how to calculate annuity numbers? Shall I repeat? Anyone? One last time I am asking. Shall I tell how to calculate this 3.791 or shall I proceed? Really? Yes, sir. Sir, after that if you don't do na, that's not, never it will be my mistake. Lifetime you are doing a mistake. FM itself is dependent on time value of money. I spend so much time in explaining all those things. Still if you have the doubt also no problem. But if the doubt is hidden, that's not my mistake. I am asking you very clearly, 3 times I asked. For one last time also I am asking. Okay, mercy petition. Shall I repeat how to calculate this 3.791 or shall I proceed? Proceed, sir. Repeat, Proceed, sir. Me stop. Sir, okay. Now multiply. 3.791 into 10. 37 point. At the end of 5th year, I will get 100, 10, 80, 90. What number I will get? 1 second. Stop. 1 second. Stop. Did they say anything about redemption? When they didn't tell anything about redemption, bond will be redeemed at par. Therefore, how much I will get? 100. 1 second. I want 5th year cash loan, 5th year PV factor, 5 years PV factor. 5 years, 5th year means I should use single cash flow formula. Clear or not? 1 divided by 1.10 equal to the 5th one. 621. Okay. Now, how much it will be? 62.10. Please total this. 100, huh? Reason is interest and coupon are same. Bond traded at par. Yesterday also I told you this logic. Now tell me, our market price is 100, 80? Far away. We calculated 10. 10%, what is the price? 100. We want the market price of how much? 80. Means it should not be even 12. Let us take a long number, 15. Let us do. Please tell 15%, 5 years, annuity, you stop, I will select a student, he will answer. Bro, you answer. Spits. Yes. 1 second, everyone stop doing. Calculate annuity and tell me the number. You are sitting and doing what? I got a doubt. Without doing annuity factor, do. One second, don't help anyone. Number please. Sir, I asked him. No, him. Yes. 3 point? Correct? Yes, sir. Very good. So tell me 3.352. And bro, you tell me the 5th year one. Yes. 5th year. 497. Correct? Yes, sir. Very good. So tell me 3.352 into 10. 33.52. What happened? Oh. Okay, na? And now see here. Please, next 0.497 into 100, how much it is? 49.70. Okay, now tell me 83.2? 3 or 2? 2. 83.22. Okay, now tell me, please, we want a price of how much? 80. One answer we got as how much? 100. At what percent? 10% we got 100. Okay, at 15% we got answer as how much? 83.22. This is also higher. Tell me. Now use your common sense, bro. Green t-shirt. You tell me the answer. You. Yes. Tell me. Now I will ask you the question. Theoretical question. Answer. How much price we got at 15? How much we got at 10? We want one price higher than 80. We want one price lower than 80 is our market price. One price was obtained as what? 83.22. We want 83.22. No. We want how much? 80. At what rate it is 80? At what rate it is 83.22? 15. One rate we want lesser than 80. Okay, that means I need to increase 15%. I need to reduce 15%. What I need to do? Increase. I need to increase this 15%. Let us take how much percent? 16. 16 you take 3 rupees. Definitely difference will come. So tell me, if you take 17, I will take for your answer. Tell me 17%. You take annuity and tell me. 3.19. Next. 4.5. 4, 5, 6. So 31.99, 45.6. Please tell me the total. 77.59. Okay. Now, first everyone tell me, understood what we are doing or not? How much is the market price getting traded? 80. Answer. 80. At 10%, how much we got? 100. Very high amount. We reduce it to 15. Means we increase the rate, price fall. Price fall to how much? 83. 83 is still more than 80. We want one price lesser than 80. So we tried it how much percentage? 17. Now you should only tell me, we want how much? We got two answers now. One at a higher rate of 15, one higher rate how much? 17. One at a higher rate of 17, one at a lower rate of 15. 10% you ignore because it is very far away from the reality. Trial and error means what? Best one we will select. Okay. At 17%, what is the value? 77.59. At 15%, 83.22. Now this is the main calculation. Please listen. What is the traded price? 80. At 17%, what is the price? 77. At 15%, what is the price? 80. We don't want 77. We don't even want 83.22. We want how much? 80. That means the real rate is not 17. Real rate is not 15. It is something different. I didn't understand. 80? Oh, you calculated 16%. Okay. I am not understand. Sir, I will calculate. Please see here. The point is, please, PV at the rate of, we have taken 15. We have taken 17. With the given numbers only we will get the answer. See there. Don't copy. Don't do anything. I will give enough time. At the time you can do. Please see the screen. Tell me. Two situations we have taken. One, PV at the rate of 15. Participation. Next one, PV at the rate of 17. At the rate of 15, what is the value of the bond? 83.22. At 17? 77.59. Very good. Now answer. How much percent change? 2%. How much value change? 5.63. Yes, 5.63. Okay. Now see here. PV at the rate of 15, bond value is 83.22. PV at the rate of 17, bond value is 77.59. For 2% change in the PV, how much bond value influence is happening? 5.63 rupees. Sorry, I'm very sorry. Rupees. So for every 2% change in the YTM or KD or return, whatever you call, the price of the bond is changing by how much percentage? Start from the beginning, see there. Tell me, how much is the first rate we have taken? At that rate, what is the price of the bond? 80.22. Then we increase it to how much? 70. Then price fall to how much? 77. We don't want 77. We don't want 83. We want how much? 80. So the rate what we want is not 15, not 17, but it is somewhere between 15 and 17. Do you understand the point or not? Yes, okay, this is a point. So now tell me, 2%, there is a change of 5.63. Yes or no? Yes, sir. Now I will ask a question, answer. 2%, 1 second, 2% fall, 2% raise. 2% raise in rate or fall in rate? Both. Change is indifferent always. It has both plus and minus. If it increases by 2, then it will, if PV increase by 2%, 5.63 fall. If PV reduce by 2%, 5.63 raise. This is not plus minus, it is a change. Change can be either positive, change can be either negative. For the first time we are doing this now, I will do both of these and show you that any way you do, you will get the same answer. Better than institute, we will present this answer now, but let me first re-explain the concept. I have doubts on your understanding. So first tell me, what is the price of the bond? How much we got at 15%? How much we got at 17%? So it is not 15%, it is not even 17%. It may be something in between 15 and 17. How much it is a question now. Shall we do? Yes, I will do and I will show you the answer directly. Please see here. At 15%, bond value is 83. At 17%, it is 77. We want the desired value of the bond. Again. See here. The desired value of the bond is how much? 80. We want how much, sir? 80. Everyone participate. If you turn head, see there and see here, gone. Please see there, concentrate. We want 80. At 15% we got 83.22. Now you should tell how much change has happened. How much change has happened? 83.22 became how much? That means simply we got 83.22, we want 80. That means whatever we got is excess by how much rupees? Fantastic. Like that, tell the second. Tell me, how much we want? Not answering. How much we want? How much we got? That means our answer, whatever we have obtained, is fall short by how much? 2.41. First tell me, how many of you didn't understand what I said here? If you say openly, I will repeat. If you don't even raise the hand in this entire 200, 250 students, I can't even understand. If you raise hand, I will repeat. Really? Yes, am I that understandable? Yes, shall we go to the next step? Yes, tell me, but one last time. 83.22 we got, but we want how much? 80. In the first case, we are excess by how much rupee? 3.22. Second case, we want 80, we fall short by how much? 2.41. We can do this in two ways. Institute will do in one way. I will show you that in two ways you will get the same answer. First, point of view 15%, point of view 17%. First, you please answer for 2% change, bond price is changing by 5.63. If you go by 15%, what is the amount we require to change? 3.22. Tell me, 2% change in the YTM changes the bond price by how much rupee? Again I am asking, 2% change in the YTM is changing the bond price by how much? 5.63. We want a change of 5.63. We want a change of 3.22. 3.22, how much percent we require is a question now. Clear or not, everyone? 3.22 into 2 divided by 5.63. Plus or minus? Plus 1.14? 4? Okay. Sorry, 1.4. Third digit also not required. 1.14. Please see the screen. We are starting from which percent? 15 plus 1.14 will become how much? 16.14 percentage. Understood or not? Yes, sir. Come from 17% now. 2% change. How much change is made in the value of the bond? 5.63. But we want a change of how much? Minus 2.41. So tell me how much a change? 2.41 into 2 divided by 5.63 minus 0.886. Okay, 86. 17 minus 0.86, how much? 16.14. Both answers are same. Everyone understood the concept clearly now? Now see here, institute also done for this question. They didn't do. They have done for another question. I think they have taken another, this question they have done. But if it has to be done for the question whatever we have done now, see here now. Okay, see here, what difference it will make between two kinds of prices? Let me explain. First, up to here everyone understood whatever we have done the calculations with? Yes, answer? Yes, sir. Tell me how much we have taken as a, interest here? How much we have taken? 10. Answer, yeah, 10%. Simply this 10% is with the tax or without tax? This is without tax. This is this model is called as YTM without tax. YTM without tax. Same question, YTM with the tax, small change will be made. That small change is, in place of 10 we will put 10 into 1 minus 0.3. 0.3 or 0.35? Yeah. Point? So how much it will be? 10 or 6.5? Now everyone in the class do in a rough. Take two percentages. I am only giving you the hint. Take 10% and 15% and do. If you want how to do this, at least to see this, you will get an idea. One second. If you have a misclarity, again I will repeat. We are going to do with the tax or without tax? With or without? With the tax you are doing now. I have done without tax or with tax? Without tax. You are going to do with the tax. Tax at same, sir, 0.35. Take the tax. 1 second. Answer, what will change? Can I know? Everything will change in the answer. What will change? Interest. 1 second. Year 1 to 5, how much you have taken interest here? See the screen and tell. Instead of 10, you will take how much there? 6.5. That means 10 rupees you have returned. Instead of 10 rupees, you will write 6.5. Remaining everything is same. That means 100 is same, everything is same, except 10, you will write 6.5. Because it will be with tax or without tax? With taxation. Remaining everything is same. PV at the rate of 10, 10 take it as a 10. PV at the rate of 15, 15 take it as 15. Don't apply taxes on that. So your working should be this way. Year, cash flow, PV at the rate of 10%, PVCF, PV at the rate of 15%, PVCF, 1, 2, 5 and 5, 6.5 and 100. That's all. Remaining information you fill. Do roughly. Sir, if anyone didn't understand, at least raise your hand, I will come to your place. If anyone didn't understand, At least raise your hand, I will come to your place. Sir, have you done? How many of you completed? Raise the hand. How many of you completed? How much answer you got? How much? 86, sir. I am asking YTM, percentage. Arey, you have to do remaining part also. Abba. You started valuing the share, bond value and you stopped. Remaining also you should do. Sorry, okay. At least up to there you tell me. Thank you very much. Tell me. If it is 10%, how much you got? 1 second, again started. 3.791 and here point 621. Okay, multiply 20 64 10. Okay, 15. Who on total? Tell everything. 352. Multiply both. 7, 49.7. So total? 71.49. Okay. Sir, up to here have you done calculation or not? How many of you haven't done this? Please make it fast. I'll wait for another 1 minute for you. I will proceed with the answer. Okay. Shall I proceed further, everyone? Respond. Shall I continue? Now, you people have done the answer. Therefore, give me answer step by step we will do. Tell me. How many percentages we considered? 1 second, everyone stop. 1 second. Answer my question. 2 situations we considered. One is PV at the rate of how much percent? 10%. Next one, PV at the rate of 15%. Tell me. At 10%, what is the value of the bond? 86.74. Okay. At 15%? 71 na? 71.4. We want 80. Sir, listen now. Please listen. PV at the rate of 10 at the rate of 15. So, value of the bond 86.74, 71.49. Tell me, for 5% rate difference, how much a difference we got? 15.25. Desired value of the bond is 86 or 80? In both the cases it is 80. So what is the change? Now tell me, we want 80, we got 86.74, we are on a higher side by how much? 6.74. We want 80, we are short by how much if it is 71.49? 8.51 na? 8.51. Okay. Now answer. I will do from both the point of view. One is 10, another one 15. Everyone see the screen. For 5% change in the rate, price is changing by 15.25. At 10%, what is the change we require? Plus 6.74. How much rate change is required? 6.74 into 5 divided by 15.25. 2.21 na? Okay, very good. Next. Will you listen or not, everyone? This is a positive. 10 plus 2.21 will become how much? 12.21. Okay, next 15. For 5% change, 15.25 change. But I need a negative change of how much? Minus 8.51. Tell me the deduction that I need to do. 2.79. 15 minus 2.79 equal to 21. In both the cases it is same. Everyone understood the point or not? Sir, now in exam I need to do with the tax or without tax? It's a question. Always do with the tax. Study material will do only with the tax, but to make you understand I have done both. Clear? That's why in my notes also I have done with the tax only. Okay? So this is the answer. First tell me, how many of you didn't understand? How many of you want me to repeat once again? Shall I continue? Yes, first, see the screen how to present in exam. We are doing KD calculation. We got a number as 11.67. It is accurate or approximate? We need to go for accuracy. Will be obtained using a model called as IRR, using interpolation. That means one number bigger, one number smaller. Using that we have done. See the screen once. Calculation of IRR or YTM. Year 1 to 5 years 6.5, 10% and 15%. These are the values. This is how you need to present the answer. See here. PV at the rate of, see the screen. PV at the rate of how much percent? 10%, and at the rate of 15%. 10% if you take, how much is the value of the bond? I am asking everyone, 10% PV factor, how much is the value of the bond? PV factor increases, value should reduce or increase? Next, PV factor decrease, value should be. Therefore, you can observe here, 10% value is more than 80, 15% value is less than 80. This is how we have done. Finally, how much is the answer we obtained? 12.21%. Any way you do, you should get the same answer. If you are getting a wrong answer, somewhere you have committed mistake. If you see whatever we have done, without tax also both matched. With the tax also both matched. In the ICAI exam, what you have to do? With the tax say correct. Always. Okay? So please copy down the notes. When you are copying, copy it neatly. First table completed? First table only. Okay, I'm scrolling down. I asked you, na? Then what you're doing? So everyone out here in this area understood the concept clearly? Anyone have the doubts? Clear? Everyone in this area understood the concept clearly? So boys also, everyone in this area understood the concept clearly? With your yes, I am moving forward to the next problem. If you have any doubt, you can ask. In exam, do both the point of views. It takes hardly extra 1 minute time, but you will get a confidence that the answer you got is accurate. So answer is 12.21. Hope everyone completed writing? I hope, that's why I said. I deem. So see there are two rates given. One is an accurate rate, one is an approximation. 11.67 is an approximation, 12.21 is accurate. Copied the answer? Before we move on into the next concept, last side analysis, much more analysis on the numbers. So let us have more analysis on the numbers in this regard before we move on and proceed to the next area. Please see the screen once. Okay. See here one. Sir, 1 minute if time gap comes, you need not talk. Listen. We don't have that much time. Please see here. Let me explain whatever I want to explain in this regard. So please see here. I will give you 3 different situations and make you to understand this particular concept more clearly. Tell me, in the case, now just now we have done the answer now. Just now we have done the answer or not. How much we got? 11.67 approximate. 12.21 is the accurate. Yes or no? Yes, okay. I will give you one small illustration. Just at least give a try. I am not expecting you to do that. Just roughly only you can do and solve it. Very easy, dead easy concept. First question. Roughly you do. Read the question first. Dead easy. A rupees 100 par value bond bearing a coupon of 11 will mature after 5 years. What is the value of the bond if the required return is 15%? First you tell me one point. Year. What are the 4 columns? Year, cash flow, PV at the rate of. Tell me the rate. 10%, 11% or 15? 15. 11 is interest. PV should be discounted using required rate. Listening? Yes, so required rate is how much? 15. Okay. Can you do the value? Yes, I am asking you to calculate PVCF here. 1 minute time. Do that roughly. For that case, I will also do with you. Year. Tell me the numbers. Year, cash flow, PV at the rate of 15%, PVCF. Tell me. Year 1, 2, 5 and 5. Cash flow 11 and 100. 15% for 5 years. 3.352. Next point. 497. So multiply. 30.87. 49.7. Please, total value of the bond is 86.57. Huh? Okay. Now, listen carefully. I have lot of discussion to make on this. Please listen. Shall we continue? See the screen once. You suspend doing all other works. Please see here. I am going to discuss something very important and interesting as well. So please, everyone listen. Let me take 3 different situations to analyze. Year, cash flow. 0 year today. 0 year today. Just now you have done the problem now. What is the value you got? 86.57. 86 point? Okay. I will ask you question, first answer and then I will write. Tell me. If you want to purchase the bond, that bond, at what price I have to purchase today? Everyone. What is a par? What is a par? What is the market price? So if I have to buy today, my NP will be 100, 86.57. Very good. So 0 year I have to pay, I will receive pay. Inflow na, outflow na? I will show in brackets. 86.57. I will show in brackets. Negative na brackets. Next. 1 to 5 years, how much interest I will receive? Rupees la you tell me. Are answer here, see and tell. How much percent? Par value? 100 into? How much I will receive? 11. At the end of 5th year, how much I will receive? 100. Analysis. See the screen. Tell me. In the given example, how much is the required rate? 15. How much is the required rate? Or how much is the return I obtained? 15. I repeat, how much is the return I obtained? 15. Company is giving me a return of how much? Let me repeat once again. Company giving me a return of how much? But what is my return? When company gives me a coupon of 11, how come I will get 15? Yeah? Either I should get 11 or I should not get anything. Company is paying me 11%. Listening? Yes, sir. See the screen? Company is giving me 11%. How come I will get 15? Yeah? I should get, if they give 11, I will get 11. If they give 11, how come my return is becoming 15? It is because of capital gain. See the screen and tell me, at what rate I am purchasing today? At what rate I am redeeming after 5 years? I am purchasing at 86 and I am selling at 100. There is a capital gain, capital loss. Capital gain, capital loss. Exactly. Coupon is 11, but my return is coupon is 11. My return is coupon plus capital gain. But my return is coupon plus capital gain. Now, I will ask students selectively answer this. This requires common sense. First, let us start with you. See the question. Why? See the question on the board. See the question on the board. Here, what is the return? First, tell me that. First case, what is the return? What is the return? In the question I have given, how much percent? 15. Why? Company pay 11, but I received 15 because of what? Company paid how much? If company pay 11, I should receive how much? 11. But I am not receiving 11. I am receiving how much? Because I didn't purchase at 100. I purchased at what? 86.57. I am purchasing at a lesser cost, selling at a higher cost, having what? Capital gain. Therefore, my return is more than what the company gives. Clear, everyone? This is one way of interpreting that. Okay? On that basis, I am asking a question. See there. I want to answer fatafat. No delay. Chipsets, make it update first. See. 90. By writing, your brain should work. 11. 100. Tell me. Return equal to C plus CG, C plus CG or not? Is it C plus CG or not? Yes, sir. 1 second. Let her answer. Hey. Not a joke. Seriously, I am asking you. There is a capital gain, no capital gain. So tell me. 1 second. C plus CG. Pakka done. Now tell me. R greater than 11, less than 11. Stop. Everyone stop. Anyway, let her answer. R greater than 11, less than 11. Greater than 11. Very good. R greater than 15, not greater than 15. Thank you very much. That's all. Everyone understood the point or not? How can you know that R is not greater than 15? Yeah? R greater than 11 means okay, understandable. But how can you tell that R is not greater than 15? Because the level of capital gain is reduced. Everyone understood the point or not? Yes, sir. Previously my capital gain is 100 minus 86, around 14 is there. Now the capital gain has a fall to, in this given case, C plus CG, only C. But not CG bigger like the previous one. So my return will be definitely higher than interest, but not like previous case where I got 15. Yes, understanding or not? Yes, now let us take another person now. Bro, for you. You know that you will be tested. Whoever I get doubt, you will definitely be selected. See there. Year, cash flow. 0. 0 here. 110, 125, 11, 500. Tell me R is equal to C plus CG. 1 second. Will you please shut your mouth? You tell C plus CG, C minus CL. CL means what? Capital loss. Okay, you tell me. Here, R is C plus CG, C minus CL. Loudly here. Means what? C means what? Hey, C means what? Coupon. Bro. Anyayam, bro. So tell me, C means what? Coupon, interest. Minus capital gain or capital loss? Capital loss. Okay, tell me. So one thing you said, it will be C minus CL. But I want one question. R will be 11, greater than 11, less than 11. Now I told you one thing. Oh, in Tamil I should tell. What I will call shut up. Why muda? Do that. Arey, what is that excitement here? Less than 11. Why? I don't want answers. Reasoning. Why? How much interest you got? 11. How much capital loss you got? Some amount of capital loss you got per annum. So, the interest amount, whatever you get, is eroded by capital loss. Previous cases, how R increased because of capital gain, here the R is reduced because of capital loss. Listening or not? Yes, sir. If third case is prevailing, R will be, the PV factor will be 11, more than 11, less than 11. Yes, answer? Yes, next. Everyone in the class can answer this question. Instead of 110, it is 100. Instead of 110, it is 100. Instead of 110, I have written 100. So now tell me in this case, R equal to 11, more than 11, less than 11? R equal to 11 means the bond will be traded at par. In that case, R will be equal to the coupon, because R equal to coupon only. There is no capital gain, there is no capital loss. Everyone understood the analysis or not, everyone? Last and final conclusion. 3 situations can happen. Listen carefully to all the 3 what I say. Situation number 1. Bond, listening? Bond issued at par, redeemed at par. Bond issued at premium, redeemed at par. Bond issued at a discount, redeemed at par. Tell me all the 3. Issued at par, redeemed at par. Stop there. First answer for that. Bond issued at par, redeemed at par. YTM is coupon. YTM is coupon. Fantastic. Bond issued at a discount, redeemed at par. R equal to coupon plus capital gain. Next, bond issued at a premium, redeemed at par. R equal to coupon minus capital loss. That's all. This is the overall analysis of a bond. Everyone understood the concept clearly? This is how the markets analyze the bond instruments. If you sit before the NDTV profit, they will analyze coupon rates, all these they will analyze. This is what they have done. In the discussion what we made, 1% also institute done in the study material. So they didn't analyze the bond instrument concept at all. And moreover, we have done the IRR calculation with the formula, without? Not YTM, IRR. 10%, 15% we have taken or not? For that also, they have taken one formula. L plus NPVL divided by NPVL minus NPVH into H minus L. This is required or not required? This is called as, when formula has to be used, formula should be used to make your life more easy, not miserable. For this I need to put a memory technique now. first L will come. Sir, shall I tell you another problem with this formula? They are taking lower values first. L means lower value. But in our concept, I have done using both. Lower value 10 we have taken, higher value 15 also we have taken. So do as per that model. Forget about this formula at all. Answer will come. Everyone understood the concept up to here? That's all. One stage of discussion of this chapter is completed. Everyone understood clearly? Now it is your turn to do the problem. Will you do? YTM concept over. Let us go by zero coupon bond. Please come to illustration 4. Please come to illustration 4. Please come to illustration 4. Okay. 1 minute, please. First, clarity point number 1, no break. Okay? So, no argument. Okay? As of now, no break. That's the meaning. Some people got BP already. I'm telling, sir, you drag, I also drag the break time. You drag again, I drag the class time. Okay? So please, let's complete everything on time. Listen carefully. Point number 1. Institutional Development Bank issued a zero interest deep discount bond of a face value of how much? 100. 1 point. Did you write the notes? This notes you have written? No. So then do one thing, you write this notes. Please see the screen there. Analysis on bond value. 3 points whatever I have taken, I have given as an example. I want only to read this. Please read the following conclusions. Please read. Bond issued at par, redeemed at par. ROR KD equal to coupon. Second case, bond issued at discount, redeemed at par. KD equal to coupon plus capital gain. Next, bond issued at a premium and is redeemed at par. ROI or KD equal to coupon minus capital loss. Everyone understood all the meanings clearly? Okay. Please write it down. Analysis on the bond value. So completed writing? Okay, take a break and come. It's exactly 4:20 we'll meet again. So take a break and come, 4:20 we'll meet back. So let's continue. So in the previous session, the first part of the today's class, we have completed calculating the KD as well as the concept of IRR. IRR, how to calculate, how to interpolate two rates and calculate. Each and every concept we have understood in detail. And we have calculated and analyzed as well the impact of capital gain and capital loss on the returns. Summary. The term KD is having alternative names. Okay, the term KD will have alternative names. You can call it as YTM, you can call it as required rate. Am I clear? You can call it as a yield, any name. It relates only to one thing called as a PV factor. Everyone understood the point clearly or not? Yes, shall we continue? Yes, listen now. Sorry, listen. Listen. So now we are going to start with zero coupon bonds. Let me first explain what is this zero coupon bond. Later you can understand the concept. Doing the problem is very easy, but please, enough sir, listen. See here. This concept is called as ZCB, also called as a zero coupon bond. Another name is DDB, deep discounted bond. What is it? Deep discounted bond. Concept is very clear to the word. No noise, we started. Listen. Deep discounting bonds means there are two things in a bond: issue, redemption. I will issue the bond at a least discounted price. Redemption will be made at par. Example I will tell you. I will issue the bond at 5,000, redeem after 10 years at 25,000. Clear everyone? Yes, tell me, issued for, redeemed at 25,000 will be the par. So tell me, what is the par value of the debenture? What is the par value of the debenture? Issued at para, redeemed at para? Issued at deep discount. 25,000 redemption means I am not issuing somewhere at 23, 22. Deep discount means when it is a par value is 25, I am issuing at 5,000. First point, everyone understood or not? Yes, so I am issuing 5 times lesser than the par value of this particular bond instrument. Clear or not everyone? Yes, these are called as deep discounted bonds, also called as zero coupon bond. So now see the screen and tell me, this bond is issued at least cost but redeemed at par. There is a coupon, no coupon? Not answering. There is a coupon in the middle 10 years term or no coupon? No coupon. Therefore we call it as zero coupon bond. First point, everyone understood the concept clearly or not? That's why we call them as zero coupon bonds. Shall we continue? One point over. Second, zero coupon bond will have a return or no return? Return or no return? Return will be there, coupon will not be there. Are you understanding or not? How much you are investing? How much you are getting? That means there is a return that is possible between these two or not? What is that return itself is the subject matter of discussion. I will give you one classic example. See the screen. Issue price 5,000, redemption at 25,000. Redemption at 25,000. Now I will ask you one question, answer. This is issue price. This is redemption price. Common sense I want. You will redeem today na after 10 years. Sir. Fantastic. Next one. Tell me. You will issue today na after 10 years. Sir. Means 0. Clear? This will be, first one. This will be present value or future value. This will be there is a single cash flow na multiple cash flow na? Tell me, present value of asset in case of single cash flow, what is the formula? Future value divided by 1 plus r whole power n. 1 plus r whole power n. This is the formula that we have to use. Here you need not calculate anything, but did you understand how to do the problem or not? He will ask us to calculate this. What we need to calculate? R. That means how much return company should give in order to reach 5,000 to 25 over a period of 10 years. That means if I get how much return, this 5,000 will become 25,000 over a span of how many years? 10 years. I repeat one last time. We are discussing about coupon paying bonds or zero coupon bonds. Will pay interest or will not pay interest? They will not pay interest. Return will be there or will not be there? Return will be there. What may not be there? Coupon may not be there, but what will be there? Return. I am issuing at what price? Redeeming at what price? That means 5,000 became 25,000 means I got some return or not? How much return is a question they will ask in exam. Did you understand the point or not? Let us take one exam question, institute exam question for 4 marks. This is how the question was tested. Question number 4. I will give time for you to copy. Please see the screen. Institutional Development Bank, IDB, issued zero coupon deep discounted bonds of face value of 1 lakh. Face value is also called as? Just now I said what it is. Par value. In a zero coupon bond, issue will be made at para, redemption will be made at para. Redemption will be made at par. Issue will be made at normal deep discount. That's why deep discount he only have given. Clear everyone? What is the issue price? 2,500 is what? Is what? They will redeem at what price? How many years? What percentage of return on an average every year this bond has given to make this 2,500 to 1 lakh is a question now. Did you understand my point or not? But you should answer to my satisfaction. Tell me, you are issuing at what price? Redeeming at what price? There is a rate of return gap or not? That means if you have paid some interest, 2,500 has become 1 lakh means at a particular rate of growth it has grown and made 2,500 to 1 lakh or not? At what rate it has grown is a question he is asking. Did you understand the question or not, everyone? How many of you didn't understand question? If you don't, at least I will get a chance to repeat it once again. Anyone want me to repeat once again? If I listen one yes, I will repeat. I don't even want who you are. Shall I repeat? Yes, I will repeat. Listen carefully. I don't know who asked me, but still, one person also didn't understand me, so I will repeat at any cost. Please listen. Point is, whenever we have a zero coupon bond, it will be issued at a least discount. That means deeply I will discount it and I will issue. In this example, the bond is issued at how much price? 2,500. But I will redeem at what price? Today, after 25 years. Means my 2,500 investment made today reached 1 lakh rupees after 25 years. Yes or no? Yes, at what rate I got a return to make this 2,500 to 1 lakh is a question. Sir, I didn't understand this way of analysis. I will give a best way of analysis to this. Listen. How much you invest today? You gave instruction to the bank. You deposited how much in bank? 2,500. Say example say, you invested how much in bank? 2,500. You invested in a bank. You gave instructions to the bank. Every year at the end, you will get a coupon or not? Don't give to me, reinvest for 25 years. Reinvest for? Reinvested? Reinvest for 25 years. Second year I will get coupon or not? Reinvest for 24 years. Listening or not? That's the idea behind zero coupon bond. That means in the middle period of 25 years you will get the interest or you will not get the interest. As if interest is paid, without giving you in the hand they will again reinvest. That impact will come in zero coupon bond. Are you understanding or not? Yes, we want coupon, we want the rate of growth. That means at what rate you are paying me the return. My 2,500 became a whooping amount of 1 lakh means some rate of return is there in the middle or not? Yes, it grown at a rate. What is that rate? He is asking the question. Clear or not everyone? Very, very important question in examination. 3-4 times already tested with a change in numbers. Let us understand. Institute has done all mess with the answer. Let us do it in more common sense way. You answer my question, I will do. I will give time for you to copy. See the screen, answer. Put calculators before you. Lot of calculation work will be there. One calculator shortcut also I will show you how to do in exam. Okay, you might have learned this in CA foundation also, nothing great, but still as my part of work I will also do. Please see the screen once. Tell me, what is the present value? No wrong answers. What is the present value? What is the future value? Future value is 1 lakh. Okay, now what is the life? This is N. Tell me what is the formula. We want PV or FV? We want PV or FV? We don't want PV. We don't want FV. They have given both. We want what? R. So first tell me, what is the formula for PV? PV equal to FV divided by 1 plus R whole power N. Tell me, what is the PV? What is the FV? Oh, just a minute. 1 lakh whole divided by 1 plus R whole power 25. So please tell me 1 plus R whole power 25 equal to how much? 40. 1 plus R equal to root of 25. Listen. 1 minute you are talking, please listen. So first point, up to here everyone understood or not? Yes, sir. 1 plus R equal to 25th root of 40. At least up to here everyone understood the point or not? Yes, sir. Clear up to here? Yes, sir. Tell me, How many times your money has multiplied? 40 times it multiplied. How many times? 40 times growth has come. It is times, not percentage. 40% illa, 40 times growth has come. From where you started? From where you started? Where you ended? How many times growth is there? We want to times growth, percentage growth. That we need to understand now. Clear everyone? Concentrate properly. Listen. Whenever 25th root, 13th root, 7th root, 6th root, these ugly roots will come. For that there is a calculator technique we can use, through which we can do without using any kind of logarithm tables, anti-log tables or exponential tables. Without using anything we can do. Let us see how to do. First, I will tell you the procedure. First follow that. Listen. We want 25th root of what? 40. See here. 25th root of 40. Institute has done all mess with it like this. Without touching those, we can do the answer just in a minute. Please everyone, take calculator, put with you. First tell me, what is the number you desire? 40. Press 40. Step 1, press the desired number, 40. Shall I continue? Yes, sir. Press square root 15 times. Press square root 15 times. Don't do anything. Don't press is equal to multiplication, etc. Or action vendor. Do whatever I say. First, what you have taken? 40. Answer here. 40. Next, how many times you should press square root? 15 times. How many times? 15 times. Minus 1. Minus 1. You want which root? 25. Divided by 25. Decide root. Okay na? Plus 1. Now, listen. Into is equal to 15 times. One point 1.15 means 15.9%. Sir, 1 plus R equal to 1.159. R equal to 0.159. Or this can also be written as 15.9% or can be also taken as 16. This is the answer. 15.9%. So what he has done, 15, 16, you need not do anything. Directly you can solve like this. Just in fractions of a minute you can do. Out of practice you can do all those things in just 15 seconds max. It will not take more than that. So how to do this? See the screen. Okay. First copy down this. Valuation of a ZCB. I will again re-explain, no worry. You copy down. First paragraph completed. Make the calculation. What happened? Have you written up to 15.9? So write down the procedure clearly. Completed? Please make it fast. Write it down. So place the design number square root 15 times minus 1 divided by the desired root number, press plus 1, after that multiply and equal to, into equal to for 15 times. Once you do that for 15 times, the number whatever you get will be for 1 plus r. Okay, 1 plus r equal to that number. Reduce 1 from that, you will be getting r. Convert that into percentage. So tell me, that particular zero coupon bond, whatever we have seen, on an average every year, how much return it has given you? 15.9%, almost how much percent? 16% return it has given. That's why that 2,500 has become 1 lakh rupee. 40 times increase has happened. That's all. This is the end of another concept called as a zero coupon bond. That is also completed. Sir, everyone first tell me, sorry, okay, thank you very much, but still, answer my question. Understood the concept clearly or not? Yes, sir. Which one you calculated now? Zero coupon bond we completed. Okay. So, next, after this, amortization of a bond. Let us see. Listen, amortization of a bond. Easiest way of calculating the bond will be the amortized bond values. Even before going into that, come to illustration number 5. Meaning I will explain through the question itself. Please come to illustration 5. RBML is proposing to sell 5-year bond of rupees 5,000 at 8% interest per annum. The bond amount will be amortized equally over its life. Calculate the bond's present value for an investor if he expect minimum rate of return of how much percent? 6%. That is the question he is asking. Okay. So, listen first, later we go into the analysis and all. I want attention. Please listen. Shall we continue? Yes, let's make the analysis now. Tell me, this is a normal bond or amortized bonds? Amortized bonds are those bonds. So tell me, bond will, for example, there is a 5-year bond. During the first year, second year, third year and fourth year, what the bond will do? What it will give you? Answer. Fifth year? 5 years, coupon anyway received. Fifth year, coupon plus what will also come? Redemption also will come. Yes or no? Yes, amortized bonds are those bonds. Proportion of principal also will be paid every year. Means 5,000 is the bond value, means every year interest I will pay. Clear? I will pay interest on opening balance. I will pay interest on opening balance and I will also pay you principal. Use your common sense. Tell me, what is the amount I am listening, everyone? Yes, now answer my question clearly. What is the par value of the bond? See the question. How many years? Divide into equal installments. How many times? 1,000, 1,000, 1,000, 1,000 and 1,000. How many times I need to pay? 5 times. Tell me. First year, what is the opening principal? That will be there for the full first year or not? Yes, at the end, how much I will pay? Balance will be. I will pay interest on 4,000 or 5,000. If you pay on 4,000, investor will wear chappal. Yes or no? If you pay interest on 4,000, investor may wear chappal or leather shoe or normal shoe. Reasons are very clear. Do you know why? I used your principal for full 1 year. 5,000 principal. Yes, at the end, I am repaying you 1,000. You will pay interest on 4,000. Do you think that investor is a fool? So therefore, tell me, year beginning, how much is the principal? I used for entire year or not? At the end of there, how much I repaid? Answer. Now, ideally you tell with an amount of common sense, you will accept interest to be paid on 4,000? I used your how much principal? Pay interest on 5,000. Last day you repaid 1,000 and pay interest on 4,000. So therefore pay interest on 5,000. So now concentrate. Everyone tell me. First year, how much principal I will pay at the end? Closing. Opening balance of second year. Repay. Closing balance of second year. Now tell me, 3,000, 1,000, 2,000. 2,000, 1,000, 1,000. Next, 1,000, 1,000, 0. That means by the end of fifth year, no principal will be balance. Interest will be paid on opening balances, not on closing. Listening? Tell me, how the opening balances look like? 5,000, 4,000, 3,000, 2,000, 1,000. Payments, 1,000, 1,000, 1,000, 1,000, 1,000. Clear? Closing balances, 4,000, 3,000, 2,000, 1,000, 0. Clear? How much percent is the interest? 5,000 into 8, 400. 4,000 into 8, 320. And next one, 3,000 into 8%, 240. Next, 2,000 into 8%, 160. Listening? 1,000 into 8%, 80. Answer over. You have to add both the inflows. You will get and PV factor should be used at the rate of 8%. 8 plus 6. 6. 8 is the interest. All wrong answers. So tell me, 8% or 6%? 6%. Now, he is asking us to calculate he is asking us to calculate the value of the bond. Stop sleeping, come back, see there. He is asking us to calculate the YTM KDA. He is asking us to calculate the present value of bond. What is the present value of asset? Any asset. What is the value of any asset? Present value of future cash flows discounted at a required rate. Tell me, what is the required rate? What is the required rate? 6%. Discounted 6%. The cash flows, whatever you get. Up to here, everyone understood? Yes, easily you can answer this question. Tell me, how much is the required rate? 6%. See the book. How much is the required rate? 6%. You are expecting? 6%. You are expecting? 6%. You are expecting? 6%. You are expecting? 6%. How much company is paying? 8%. It is paying what you require. It is paying more than what you require. Happy or unhappy? Happy. Price of the bond will rise or fall? Rise or fall? See the value of the bond in the answer. Higher than 5,000, less than? That's what I also tell. Everyone understood the analysis or not? So one thing, by seeing the question you can answer. Answer should be more than 5,000. If you get answer less than 5,000, 100% damn sure somewhere wrong answer has been given by you. Somewhere your workings are wrong. Tell me, how much you require? 6%. How much company is paying? 8%. Happy or unhappy? Happy. Market is happy. So the trend of bullish will start. Immediately the prices of bond will raise. Prices will raise. 5,000 bond will be trading somewhere at 5,000 somewhere. Some answer he got, no? 5,000. That one will come. Okay. So please do one thing. Copy down this. Nothing great, sir, but just it is in study mat we have to do. First answer one question and then do. Amortized bonds means what? What is the nature of these bonds? Generally, normal bonds, what we will do? We will pay interest every year and the coupon will be repaid only at the end of last year. But in case of amortized bonds, what they will do? Every year some amount of principal will be repaid. Previous bonds are called as plain vanilla bond. You can Google after class, not now. Don't click vanilla and stop. What do you have to click? Plain vanilla bond. Do you know vanilla cone ice cream? Like this you shout also for required return, zero coupon bonds, everything. So tell me, cone ice cream you know, na? Yes, sir. So down below there will be small portion of ice cream, but suddenly so therefore like that, plain vanilla bond means slow interest will come, but the last year big principal will come. Therefore, those they will call as what? Plain vanilla bond. You can search in Google also after that. What is the meaning of a plain vanilla? When the company pays coupon every year and pays sudden principal, now we call it as a plain vanilla bonds. These are all amortized bonds. Okay. Do the answer. Read on everyone. Valuation of an amortized bond. Valuation of an amortized bond. Valuation of an amortized bond. So, amortized bond is a bond which repays the portion of principal along with interest if any. Therefore, cash flows every year will be uneven. So, this is a multiple even annuity cash flow, multiple uneven. Multiple uneven. You are receiving two inflows if you see there. One, you are receiving the principal and you are also receiving the coupon. 1000 rupees principal, 400 coupon, first year 1400. Here and there because of decimal changes, small changes of 5-6 rupees will come, ignore it, no problem. This is only question. Yes. First year. First year 5000. You should calculate interest on opening balances. Yes, 5000 into 4% became 400. Yes, first year we repaid 1000. That means second year only 4000 principal is used. Whatever the principal I used, only on that I will pay interest. First year, if you observe, full year 5000 is utilized by company. Therefore, you need to pay interest on 5000. 5000 into 8% became 400. I repaid 1000 at the end of first year. Second year fully I utilized 4000 principal. 4000 into 8% became 320 rupees. So now you can ask what is your doubt. First year, that is for first year. Opening balance, to give an example, I said the first year. First year you will calculate principal on 5000. You utilized it, over. Second year, I didn't utilize 5000 principal, 1000 already paid in the first year. Second year beginning, I will have a principal of only 4000. Second year fully I utilized 4000 principal, on that I will pay interest. When I don't use the principal of 5000, why like a fool I will pay on 5000 interest? By basic common sense also, when I am not using the principal of 5000, why I will pay interest on 5000? At the end of first year I repaid 1000 rupee principal. How come I will pay still interest on 5000? When I already paid you your 1000 rupees. Second year I utilized only 4000. On that I will pay 8. Example sake I said first year you will pay on 5000, not on 4. Not on closing balance but on opening. To take that example I said. Sir, by the way, everyone understood the logic what I said or not? So do that. If anyone have the doubts, you can ask. Sir, completed doing everyone? Okay. Below write down note. Below add a small note. Since the bond Sir, okay, just keep the notes and stop. Let everyone complete. After that I will dictate the notes. 5275.28. 6-7 rupees difference, if it comes, ignore, because that's because of the decimal. Sir, okay, listen. How much is the expectation of the general market? Again you are missing the track. Please listen, come back. Not yet completed. Tell me, how much in general market is expecting? Market in general is expecting 6, but the company is paying how much? Since company is paying interest more than what the market is expecting, market runs on a bullish trend. The prices of the bonds will increase. Clear? So please write down the note below. Since the company is paying a coupon. Since company is paying a coupon at a rate more than what the market is expecting, at a rate more than what the market is expecting. The market runs on a bullish trend. The market runs on a bullish trend. The market runs on a bullish trend and prices of the bonds tends to increase. Prices of the bond tend to increase. Prices of the bond tend to increase. So that's why the bond price is trading at 5275, though the par value is only how much? 5000. First point, everyone tell me, understood the concept or not? Yes, okay. Last question on bonds concept. Sir, how many illustrations in the study material we completed? 5. See here. Once again, see the screen. Everyone see the screen once. Institute has done this way. 5000 into 0.08. 5000 minus, like this they have done. Later again they added all these separately. They have taken this formula without doing all these things in one single table. You can make your life more easy. Okay, the answer will essentially be the same. What is the last thing we are going to start? Convertible debentures. Everyone tell me, what is the topic? Convertible debentures. With the completion of this concept, the first area of this chapter will be completed, called as a cost of debt. Today at any cost we will complete that. Okay, not just completing this, we will also start with the next area called as preference shares. What is it? Preference shares. Okay, next session we start with KE. Till now what we completed? KD. Today we will also complete KP. What is KP? Cost of preference. Once after that there is another one concept. What is that? KE. Okay, cost of equity. Later KR. Similar to cost of equity, nothing great. After that WACC will start. Weighted average cost of capital. That concept will start once after completing this. Shall we continue? Yes, sir. Please see the screen. Cost of convertible bonds. Before we... Shall we continue? Yes, sir. See here, sir. Let me first explain the concept of convertible bonds. Once you understand this, we can do the numerical illustrations. First one. Two popular instruments are there. One is equity, another one is a debt. Equity is having advantage and disadvantage. Debt also has an advantage, disadvantage. Nothing great. Advantages of equity are the disadvantages of debt, and vice versa. Why? See the screen once. The advantage of having equity share, there will be growth. Increased growth will lead to increased share prices. So there will be a share in prosperity. Prosperity means growth of a company. Example. Company's growth is evaluated through what? Company's growth is evaluated. This company is a growing company. This company is a non-growing company. How anyone in the world can decide? Share prices. What is the indicator? Share prices. Public sentiments are always reflected in the form of what? Share prices. Are you understanding or not? It will be like a mirror image of the company. Share price is a mirror. It will show what company is doing. When prices of the company are falling, it is an indication to the board of directors something is going wrong, rectify immediately. Clear or not, everyone? Yes, okay, you stand before a mirror. Okay, somewhere you found a scar on face or a hand, etc. Immediately you will take an action because I can't see my face like this. There should be something required. Yes or no? That mirror will be there where I can see myself and I can see check what is wrong. Same point will come even in case of company. The mirror to the company is what? Share prices. Share prices are falling. It is an indicator something is going wrong. Share prices are rising. It is an indicator that some positive sentiments are affecting the company. You should not take so easily. Prices fall and rise every day. Clear? 1 rupee, 2 rupee changes you need not consider. But if the company share price is going on falling every single day, something is going wrong. Shareholders came to know about some important information about your company which is adversely affecting the company. Prices will fall. See the screen once. Whenever I have an equity share, the greatest advantage is growth in prosperity or share in prosperity. Example I will tell you. Tell me, I purchased a share. Listening? I purchased a share. Say I purchased a share at 100 rupees. Company is performing well. Share prices will rise, will not rise. 100 becomes 120. Again better performing next year also. Continuously 5 years hit by hit. 100 rupees share price went to 400, 500 rupees. Chances are there or not. So many cases, practical cases have happened in the real life scenario where the share prices went up like that. History is also there where share prices are falling like that. Classic 3 examples I will give you. LIC, Zomato and Paytm. LIC, Zomato, Paytm. Classic examples. LIC issued at 900 rupees. Now not even having a 600, 650. Zomato issued at 2000. Now trading at 600, 700 rupees. Try to understand, steep fall is there. Like that rise is also there for so many companies. Are you understanding or not? So, market la share prices of fall is there, rise is also there. Now answer my question. I am a debt holder. I am a debt holder, debenture holder. Company la sales increased, multiplied. Literally last year 1 lakh units, this year 4 lakh unit sale. Bumper profit. Debenture holders will get extra interest. But shareholders will get extra profit or not? That's called as a share in prosperity. That's the advantage of a share. That becomes disadvantage to the debenture. No share in prosperity. Company is prosperous, making heavy profit, but I am not getting any rupee out of that. I will get a fixed interest only. Clear or not, everyone? Clear or not, everyone? Next, disadvantage of equity. No fixed return. Tell me, prosperity is there, fantastic. Prosperity not there, okay. Not so bad, not so good. Even if it is prosperous, is there any guarantee that every year company has to pay a dividend to you? That means fixed return, no fixed return, no fixed return. But that becomes the advantage of debt. In a debt, what will be there? Fixed returns will be there. That's the advantage of having a debt fund. Everyone understood the point or not? Tell me, what is the advantage of equity? Share in prosperity. Everyone from the last to first. What is the advantage of equity? Share in prosperity. What is the advantage of debt? Fixed return. What is the disadvantage of debt? No share in prosperity. What is the disadvantage of equity? No fixed return. What if I combine both advantages? Is the concept of convertible bonds. Convertible bond is a combination of dash and dash. That's all. When equity and debt combines together, we call them as convertible bond. Very, 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 very popular in India. Almost all the companies today, listed companies, are having convertible debt bonds. How it works, let me explain. Name lane very, very clear. Convertible bonds. Section number I am talking about. Okay? 62 of Companies Act will discuss about issue of shares. Section number 71, subsection number 1 and 2 will discuss about debentures. 71.1 will talk about debentures. 71.2 will talk about convertible debentures. But section, if you want a reference, what is the section? 71, section number 71 of Companies Act. Okay, there full clarity will come about the legal intention of bringing the convertible bonds into the Companies Act. But before going into that, understood the basic logic of convertible bond or not, everyone in the class? Yes, sir. So tell me, summarize everything and tell me, advantages of bond and share are merged together to form an instrument called as convertible bond. How? And how it gives advantages, let me explain with an example. I will issue a convertible bond. I will issue a convertible bond. Please see here. When I issue a convertible bond, this convertible bond when issued will have A percentage of interest. What will be there? Percentage of interest. Everyone observation required. See there. Debenture will have a percentage of interest. Share, no percentage of interest. Convertible bond will have a percentage of interest. Sir, then convertible bond is a bond. There also percentage is there. No. Tell me now, I will ask you one question. Use common sense only, nothing more than that. You invested in a convertible bond. Okay, you invested in a convertible bond. Market share price is skyrocketing. Every single day, minimum 2-3% raise. 1,000 rupees share became 1,010 rupees next day. Next day 1,020. Next day 1,028. Next day 1,040. Every day raise for the share. As a bondholder, seeing it, you will be happier, unhappier. Very much unhappy because you can't enjoy that. Are you understanding or not? Yes, sir. Second example. Tell me. I hold a bond in my hand. What in my hand? Bond. In the company's share market, the prices of the shares are falling like anything. I will be happy as a bondholder, unhappy. Very happy because even though the company performance is very bad and the prices are falling, I will be getting the same interest or not? Yes, sir. Merge both of them. See here. Merge both of them. Let us understand the scenario this way. I am not having debenture. I am not having a share. I am having a convertible debenture. Listening? Yes, sir. Bond. Market price increase. Happier, unhappier? Not answering. Start from beginning. I am a bond holder, not convertible bond. Prices of shares are increasing. Happier, unhappier? Happy. Why? I am not getting that share. Na? Next, as market share prices are falling, happier, unhappier? Happy. Very much happy because even though company is performing bad, I am getting my fixed coupon. Yes, listening everyone? Yes, merge both. I am not holding the bond. I am not holding a share. I am holding what? Convertible bond. I am holding. Now answer with common sense. Market is downfall. Company performance is not so great. Market price is coming down every single day. Okay? As a convertible bond holder, you will convert the share, convert the bond into share, you will keep it as a bond. Why? If I convert now, I have to take that loss. Then you will continue as a? Not answering. Then you will continue as a? And get fixed. And get fixed. 2-3 years completed. Company started performing well. Projects are getting successful. Year by year profits are increasing. Share price from 100 reached to 300-400 almost. Now you will tell me you will convert into share or will not convert? Once you convert into share, you can enjoy the prosperity of the company. Yes or no? Yes, that's why convertible bonds. Everyone understood the concept clearly or not? Market, company is not performing great. Keep it as a bond. Company is performing too well and you are confident that it will continue in the future. What you will do? Convert into share. Advantage or disadvantage? That's why they became very popular in India. Especially a country where you can't believe anyone. So that is one of the most hedged instrument, very, very popular. How can you believe a company by putting your money? Whether it will be a successful, hitta, fatta, how do you know? Clear or not? That's why today if you observe, all the companies going for IPOs. Going for? Can you please explain me what is IPO? Initial public offer. That means company's official begging starts from that day. Begging whom? Public. They will come with a bowl, begging start. For whom? Company. Tell me, sir. I will give you one example. Maybe big companies like TVS, MRF, all these you might know, which are in this state. There are so many other companies also in this state. Okay. Sir, you are studying in KS Academy. You know that this is a company. Yes or no? Normal engineering graduate, etc. If you ask, do you know KS Academy? Means chances are very slim for knowing about an academy because this is a company or not? Answer, yeah? Yes, tell me now. Company means there is a logic that everyone should know about the name. 20 Microns Limited. Have you heard? 20 Microns Limited. Have you heard? It is there. After class you search. What is the name? 20 Microns. They manufacture polythene bags. Okay, 20 Microns Limited. They will manufacture the polythene bags. So that company is also there. Good share price, 60 years, 70 years share price is also there. So that company is also there. But there is no logic that everyone should know about me. Okay? Now tell me, just one house after me, my neighbor don't know who I am. How come public will come forward to invest in my company shares? Question will arise or not? Therefore, all the companies, before going for IPO, to show what they can do, first they will issue convertible bonds to public. What they will issue? What is the advantage for the public? You buy the bond here. If I am not performing now, I will pay you interest. If you believe that I am performing, convert into share. When you go for public issue now, you will get a very good share price. Are you understanding or not? Yes, so advantages or disadvantages? Tell me now. Convertible bond, what is the advantage? It will merge the advantages of both bond and a share. Bond and a share. What is the advantage of bond I take? Fixed return. What is the advantage of share I take? Share in prosperity. Company is not performing well. Keep as a. Keep as a. Company performing too well. Convert it to share. But the one small disadvantage of convertible bond is reconversion not possible. Abba. Then in the world there will be only convertible bonds. Then everyone will take convertible bond, convert into share when the price are rising. Price are falling now? No, tuch, I will go back. Again I will go back to normal share, normal bond. That is not permitted. Once you convert if you have a confidence. Clear everyone? Now last query for you. Tell me. With common sense again. Market requires not great logics. It requires only that's all, a sheer common sense, which we always lose. Tell me, answer one question. Convertible bond is a bond or share? Bond or share? Both. Both leave a bad answer. Bond or share? Bond or share? It's a share. Reasons also I will tell you. Without reasoning why I will tell. You should tell me what. Listen. So listen carefully. My point is, it is a share. People call convertible bond as a share which is previously a bond. Reasons I will tell you, listen carefully. Listen. Bond when you hold will have a life. When you hold something as a bond, bond has a life or no life? Answer. 5 years bond. In the 5 years, so at the end of 5 years, so you will convert that into share. Share life is what? Answer, yeah. That means the moment you buy the bond, it lands only for around 4-5 years. At any moment you need to anyway convert it. After conversion it becomes what? So the convertible bond life is more in the form of a bond, more in the form of a share. Answer, yeah. Then 99% of its life is covered by share and 1% of its life is covered as a debt instrument, means which is significantly covering it. Answer. Then what you should tell? That's what I also said.
Why it is coming under convertible?
Listen carefully. Why it is coming under? One second. Let us listen to her question. Now ask the question.
Then why it is coming under KD, sir?
Why it is coming under KD? That's the question. Listen, don't get excited. Listen. Answer is, when you are issuing as what? Bond. That's all. Game over. When you are issuing as a bond, when you are issuing, the nature is what? Bond. I am asking, convertible bond by nature, when you issue it is a bond. For first 3 years or 4 years or 5 years, so it will continue as a bond. Substantial life is covered with what? Share. I am asking general market common sense meaning. Convertible bond you will see as a bond, but market will see it as a share, which is previously a bond. Because try to understand, once I convert into share, can I have a chance to reconvert? No. Means substantial life of a convertible bond will be in the form of a share or bond. Then when the substantial life is covered as a share, why we will call it as a bond? It is a convertible bond at the time of issue, that's all. But people will see it as a share, because at any point of time you have to convert that into share and continue as a shareholder only. Clear everyone? Yes, listen, how many years is the life of convertible bond in our example? 5. You can convert during 5, you can also convert at the end of 5, but at the end of 5th year you are forced to convert into equity share. Are you understanding or not? Perpetual convertible bonds will not be there in this world. Which one? Perpetual convertible bond. Convertible bonds will have a life, 5 6 7 8 10 some life will be there. That means at the time of issue, when I am issuing, I will issue as a what? Answer by everyone. Convertible bonds at the time of issue, I will issue it as a, but you can convert into at any point of time after issue. Once you convert, it becomes continue as a till what? Perpetuity. That means substantial life is as a share or as a bond. That's all. That's why people call convertible bond as a share, which is previously a bond. Clear or not everyone? Yes, another way of analysis. See here. As I already, listening everyone? Yes, as I already said, convertible bond is a share. I can give significant meaning also in this way. See here, the point is very clear. Convertible bonds, whenever you issue, at some point of time you will convert into share or not? Yes, everyone answer? Yes, you are technically, I am buying a convertible bond. I am buying a convertible bond. Really you are buying a share indirectly. You are buying a share, but indirectly. Let us understand with some amount of common sense now. You can buy a share. Shall I continue? Last bench. Shall I continue? Shall I? Permission. If you give permission, I will start. Permission granted, please. Please. Permission granted. Thank you very much. Listen. Everyone listening? Yes, convertible bonds and the shares. Convertible bond cannot be perpetual. At some point of time you need to convert that bond into a share. Means mandatorily that will convert into share. You can buy a share in 2 ways. Directly go to the stock market and buy the share, or buy a convertible bond, have a safe journey for some time, then convert into share. That means I can buy a share in how many ways? 2 ways. Answer. 2 ways. One, direct purchase of a share. Second one, first purchase as a convertible bond, and then you will convert that into share. That means at the end, your intention is to buy a bond or buy a share. That's why they call it share. Are you understanding or not? So then why we are doing here? At the time of issue, it is not a share, kada. Though it is intention is to convert into share, at the time of issue, it is a share or bond. Therefore, for the time of that 5 years, we will treat it as a bond. Clear everyone? So if you go into market, convertible bonds you are seeing in the market, you open demat account, convertible bonds are getting traded. With what intention you will buy them? To get interest? Really, if you want interest, you go for a bond. Yes, if you want, interest. If you want, interest. If you want, interest. If you want, interest. If you want interest, you will go for what? Why you will come to convertible bond here? Convertible bond you are coming when there is a normal bond in the market for the same company. Why you come for convertible bond? Because my intention is not to buy a bond. Did you understand or not? A company is there, normal bond is there, convertible bond is also there. This will pay interest, that will also pay interest. Equal interest they are paying. Tell me, why you are not going to bond? Why you are coming to convertible bond here? If you want to keep it as a bond, both are bonds only. Then why you are jumping into the second side? Reason is, your intention is not to buy the bond, your intention is to buy the. But the turbulent market conditions, to protect against it, you are keeping it as a convertible bond. When you feel that market is leveled against turbulence, immediately will convert into share. So the convertible bond is really a share in the debt's shadow. Are you understanding the point or not? So, but issue timeless, since it is a bond, we have to value as if it is a bond. Clear or not, everyone in the class? Understood or not? Now answer this. From this, there is one small question given in the study material. They didn't give illustration, they have given only example. But before that, please copy down this notes. Please copy down, make it fast. Convertible bonds concept. You write down. While writing, I will ask you question, listen and answer, and then write down again. At the time of redemption, fifth year ending, if you don't convert, you will get redemption or not, everyone? Yes, sir. There are two types of convertible bonds: compulsory convertible, optionally convertible. What is the first one? Compulsory. Second one? Optionally. Compulsory convertible bonds are governed by CA final. Optionally convertible are given in CA inter. Means at the end of fifth year, you have two options. Number one, either get a redemption directly from the company or convert that into share. These are the two options. Okay, that's why in the third point, when it comes to redemption value, the higher of cash value or stock value of redemption is considered. Meaning, I will tell you through the numbers. If it is a but you purchased it, favorable market is not there. Therefore, what you will do? You will get the redemption value better than that. For example, market share price, you estimated it should be somewhere around 120 and you bought 5 years back. Share price came to 85. Then what is better? Getting 85 share is better. Redemption at 100 rupees is better. That's why you will do. Intention at the time of investing is only to convert it to share. That's all. Completed writing. Theory, don't copy the answer. You are copying answer, eh? Write only the theory concept. We have to solve the question. Okay, let us see the example. Everyone, I have given you the page number clearly. Example in page number 4.13. Since there is no illustration given in the study material, we are going to do the example. Shall we continue? Yes, see the screen. A company. No noise, please. Sir, almost another 40 minutes. So please listen carefully. No distraction, because we have to complete the debentures and we also have to start with the preference. At least I will start and complete one problem inside. Two problems are there, one problem we have to complete. Clear? If two are completed, fantastic, or else at least we need to complete one. Please see the screen. Let us do the answer. Before that, I will first explain. Read. A company issued 10,000 15% convertible bonds at rupees 100 with a maturity of how many years? 5 years. At maturity, debenture holders will have an option. Compulsory convertible, optionally convertible. To convert debentures into equity shares at the ratio of 1:10. Means what? For every one convertible bond, how many shares are given? 10 shares will be given. Clear, everyone? Next. The current market price of equity share, how much? Rupees 12 each. And the historically the growth rate of the shares is how much? 5% per annum. Calculate the cost of debentures assuming 35% tax rate. First, answer my question clearly. Give the information what I want. First, answer one question one by one. See here. Shall we cover the concept? Yes, sir. Listen to the class properly. See there. See the screen, everyone. I have one question to ask. Tell me, what is the issue price of convertible bond? What is the issue price of convertible bond? 100. What is the interest rate? One convertible bond will have how many shares inside? Answer. I will do as a rough calculation. First, see here. One convertible bond will get converted into 10 shares. Clear, everyone? Now tell me, what is the current market price per share? Rupees? I will get, you can read question and tell this answer. I will get conversion option any time at the time of redemption. See and tell. That's why this is a problem with you. You don't read question properly. In this question, I can convert into share at any time on maturity. Everyone? On maturity, what is the share price? Wrong. 12 is the share price today. There is a growth of 5% every year. If you observe there, see the screen. See the screen. Future value equal to present value into 1 plus r whole power n. What is the present value? 12. What is the growth? 0.05. For how many years? 5 years. So 12 into 1.05 whole power 5. Value please. 15.315. Sir, I will take 32. Okay, now. See the screen? Tell me. I repeat one last time. I am buying a bond, convertible bond. Response is very low in the class. I will purchase a bond, convertible bond. This convertible bond will have a ability to get converted into how many shares? To any time on maturity. Means on maturity, my wealth will be in the form of bonds, my wealth will be in the form of shares. One share, what will be the price after 5 years? 15.32. What is the current price? 12. What is the estimated price after 5 years? 15.32. Because there is a general tendency of share price growth of 5% every year. Clear, everyone? Yes, sir. Now answer my question. Answer my question. This is 1 share price, 10 shares price. Fantastic. Now you should answer me. This is 1 share price. Means 1 convertible bond will have how many shares? 10 shares. Means if I convert 10 shares into 15.32, I will get 153.2 rupees worth shares I will get. Yes or no? Yes, sir. If I get the redemption from company without converting into share, how much redemption I will get? 100. Answer. 100. Getting 100 is better. Getting 153 worth shares is better. So you will advise your client to convert or not to convert? That's the answer given. Everyone understood the point clearly or not? Now understood the logic of convertible bonds? That's the meaning, sir. So see here, this is what he has done. Shall we continue? Rupees 153.12 will be taken as a redemption value as it is higher than cash option. What do you mean cash option? What do you mean by cash option? At the end of 50 year, you will convert or you will take redemption value. Then you will get only? Then you will get only? Which is better? That's all. Another one last question, please. Another one last question before we go on into the next point. Tell me, this particular convertible bond is issued with an interest rate of 15% or not? 15% or not? Now answer. You are converting it at the end of 5th year. If you take, listen everyone, if you take convertible bond to the company, said that I don't want to convert into share, I want to convert it into bond, or I want to take money directly, means you will give your bonds and you will get how much in hand? One last time I am asking, listen. Instead of going for a conversion into share, what you have done is, you have asked the company, give the cash, I will leave the company. So how much cash the company will give you if you don't convert into share? 100. What is this 100? Redemption value. Nothing is said. Bond is always redeemed at par. What is a par? 100. So tell me, at how much price I invested? 100. At how much price I invested? 100. At how much price I am redeeming? 100. How much interest you got? 15%. Your return will be 15%. No doubt in that. Yes, clear everyone? Yes, sir. The main advantage of convertible bond in the percentage terms I am going to explain you. Listen carefully. Tell me, how much you put in the market? 100. You stayed for how many years? 5 years. At the end of 5th year, share price went up to how much? 15.32. 10 shares will be 153.2. Listening. Yes, sir. One convertible bond has how many shares? 10 into 15.32, 153.2. That means technically, where you need to get 100 redemption, you are now getting how much? 153.32 worth shares are there in my hand. Yes, I thrown these shares into the market. I sold. How much will be there in my hand? Listening or not, everyone? Yes, sir. At the end of 5 years, how many bond? One bond I have. I will convert it into how many shares? One share value is 15.32. Okay, 10 shares are there. Means I have shares in my hand. How many shares? 10 shares. Say one convertible bond I invested. At the end of 5th year, how many shares will be there in my hand? 10 shares. 10 shares worth is how much? 153.2. I sold these in the market. How much will be there in my hand? Cash or share? cash. If I redeem in the company, I will get 100 cash. If I convert into shares and sell them and get the cash, I will get 153.2. Now tell me, my RV in this case will be 100, 153.2, 153 point. Using that, you need to calculate the KD for convertible bond. RV place instead of 100, put 153.2 and do the answer. Did you understand the point or not? I will ask questions, input data you give me. I. Number. I interest. Tell me, you are in first bench, therefore I can hear only this. So tell me, I equal to how much? Everyone. T. Tax. T. Point plus formula RV minus NP by N. What is RV? Yes, minus NP divided by whole divided by 153.2 plus 100 divided by 2. You will get a KD or not? Yes, accurate, approximate? Approximate. Using that, what we have to do? Accurate. Do that now. Do. Up to here you copy. First you copy up to here. Those who are seeing the answers and doing, you will fail in exam. Yes, tadhastu. Don't see the answers, try on your own. If you do wrong also, fantastic. But don't copy the answers from the study material or from the notes. You do on your own. Yes. This one you can copy. Up to here, okay. I'm asking KD calculation. Completed copying up to here? Please do the return calculation. Please do the return return means I mean KD. Return. Please do the return calculation. How much is the redemption value? 153.12. 12? Something. 153.15. So 153.15. Don't see the answers. What completed? That is approximate. Do accurate. Oi, 80% return. Then entire India will invest in that company. Bro. Give me. Day, plus day. Plus day. So do the accurate. Everyone done the normal KD calculation? Yes or no? How many of you didn't complete it? Do. Make it fast. Redemption value is? Yes. Correct. How much you got? Don't cover answers.
Wait, sir, do it.
How much you got? Doing, How much you got? Varala. How much you got? Correct. So 16.1%. Everyone has got a? Yes, sir. But that 16.1 is not accurate. It is only an approximate number. We need to calculate accurate return. For that, take IRR. See here, this is the answer, 16.1. But you need not do IRR, just I ask you to do IRR. Have you started doing IRR? What are the two rates you have taken? One second, listen. You have taken 17, 15. Sir, if you take 15, you will get the answer as 100. Because what is the coupon rate given in the question? Answer, yeah.
15%.
So you do. So one small point before you start. Up to 16.1 everyone has done? Yes, when I ask you a question to calculate the exact return or approximate, whatever the case, maybe you got an answer as 16.1. Now answer one question. You have to calculate IRR, yes or no? Yes, now if you want to calculate IRR, you will take one rate. Some rate. Okay? Some rate you will take. 1 to 5, how much you will take? 1 to 5, first 5 years. How much you take? 15. At the end of 5th year, how much you are taking? 153 point, 15, that you have to take. You should not take 100. Why? You are getting redemption 153.12. What? Why? How many of you taken 100? Let me know. Wrong. Then you need not do the problem. 15% will become KD. That is a K. 1 second. Let me explain, at least if you don't have a clarity. Have you done up to 16.1? Yes, up to there understood? Yes, I will ask you one question, answer. Convertible bond cost he is asking, if you convert it. If you convert, how much will be the redemption value? 100 or 153.12? On that basis only you should take. You should consider with tax. Hello, while calculating, did you take the tax? Year 1 to 5. 1 to 5. 15 will not be taken. 15 into 1 minus 0.35, because in the YTM formula 16.1 you considered the interest already. Tax. So you have to take also in the table after tax. You have taken with the tax, without tax, huh? I think you are sleeping. 1 second. Wrong. See here. 15 into 0.35, 5.25 minus 9.75. Why you are writing 6.5? Did you understand? How much interest you are getting? 15. 15 after tax will become how much? If it is 10 rupees, it is 6.5. 9.75 should be your interest. Okay. Everyone please help me with the numbers. Year cash flow PV at the rate of 14%, PVCF PV at the rate of 18%, PVCF. Year 1 to 5 and 5. Year 1 to 5, 9.75 you will get, and for the 5th year you will be getting 153.12. 12 or 15? 15. PV at the rate of 14. Randomly I am taking. For 14%, can you please tell me we need to get 3 point? Next, 5th. 5. PVCF, please. 1 second. How much? $122. 122.9. 33.47. I have no calculator here. I am writing what you said. 33.47. Recalculate it. 112.97. Okay. 18% also, please tell. 3.127. 437. Okay. 35 point. 1 second. 30.49. Okay. Next. 66.95. 93. Please tell the value. 97.442. Okay. Please listen. Listen. You may take a different percentage. I may take a different percentage. Almost 2-3 decimal difference, same answer everyone should get. Okay? Tell me. At what price convertible bond is trading today? I am not asking share price. Share price redemption value is 153. At what price the bond is trading today? 100. We got 100 is the market value. One price we got 1 second, I will write to the other side. One higher price we got 112.97. One lower price we got 97.42. This was obtained at the rate of 14%. This was obtained at the rate of 18%. 18 or 17? 18. Listen. If you listen, I will tell something. Please see the screen. Let us go back to any problem you have done till now. IRR, we have done one of the previous problem already or not? 80 rupees we have taken there. Not answering, start from the beginning. Tell me. Previous problems, one of the problem, yes. 80? What 18, 14? Okay. 18, 14, okay. See, please. In one of the previous problem, we have taken 80 rupees bond price. 80 rupees bond price. One we got 71, another we got somewhere around 80, 87, 86 or something we got. Now listen. Listen. 80 is the current market price of the bond in that question. 80 is the current market price. In this question, what is the current market price of convertible bond? 100. So we need to reach that 100. Clear? Redemption may be 153. Irrespective of that fact, we need to know what is the cost of this convertible debenture. See the screen and tell me. PV at the rate of. Tell me. First, what percentage we have taken? 14. Next, what percentage I have taken? 18. What is the value of the bond at 14? 112.97. What is the price at 18%? Some are very busy in copying the answers. Please see the screen. 18% what is the value? 94.2. For 4% change, how much value change is there? 15.5. 15.55. Desired value of the bond is how much? 100. What is the change? I have additional 12.97. Here I have a reduction of 2.58, huh? Very good, okay. So we can take from 2 point of views, 14%, 18%. For 4% change, 15.55 rupees change, we want 12.97 change. Tell the percentage. 3.34, total it is 17.34%. Next, come here. 4%, 15.55 minus 2.58, tell me the value. Minus 0.66. 18 minus 0.66 will be 17.34. In both the cases, answer tallied. This is how we need to do. Always remember, whenever you calculate IRR, current market price should be the base, not redemption. What should be the base? Current market price. Okay. This is how you have to do. So tell me, approximate answer, how much you got? Approximate answer 16.1. What is the accurate answer? 17.34. Institute didn't do this accurate, you do this. First point, how many of you didn't understand what I have done? How many of you didn't understand what I have done? For the third time I am asking, how many of you didn't understand what I have done? At least one yes, everyone understood properly? Yes, sir. One more time? Yes, sir. Understood the entire concept clearly? Yes, sir. But one question answer. IRR, whenever you do, comparison should be with the current market price of the bond. Here it is a convertible bond. 153.12 is what? Redemption value. Why you are looking into redemption values unnecessarily and comparing? Clear or not, everyone? So that's the main point that you need to understand here. Okay. 17.34. I will ask you one last question. Observation question, not numbers. Listen, I will ask you one question, answer this. Convertible bond is giving a return of 15% if you see the question. See the question. You are in a hurry to leave the class, I understood. But still, I won't leave unless and until I get a correct answer for this. Answer the question now. Convertible bond. It was given in the question, huh? Example 3. Where is example 3? See the question once. What is the market price of the convertible bond? Market price of the convertible bond? 100. Issue is also made at? 100. Issue is also made at? 100. Par value is also 100. Means bond is traded at what? Par. So you should only tell me. Normal bond, let us assume, not convertible bond. Normal bond you are buying. Tell me, what is the RV? What is the RV in this question? 100. What is the purchase price? 100. Capital gain or no capital gain? Therefore, KD will be the coupon rate only. I told you this or not? Yes, sir. KD will be coupon rate. So what will be the KD? 15%. Coupon is how much in the question? 15%. So KD will become? 15%. KD will become? 15%. But because of holding a convertible bond, your return is 17.34. That's because of appreciation, because of share values. Are you understanding the point or not? If you keep it as a convertible bond, how much return you might have got? 15% you will get. But now how much you are getting? 17.34. That 17.34 is obtained because of putting it as a bond, because of converting into shares. Therefore, any person in this world will buy convertible bonds to convert it into shares and get a high value. That 2.34 is called as share in prosperity. Are you understanding the point or not? Yes, write down the notes below. Completed writing up to here? Write down. Conclusion. All these are not given in the study material. They didn't do any analysis. But we have to do and complete it. Conclusion. Write down conclusion. If the investor, sir, if anyone has to leave, you can leave, no problem. Nothing great I am going to explain. Just notes whatever I said. If the investor invest in convertible bond, if the investor invest in convertible bond, if the investor invest in convertible bond and do not convert it, he will get a return of 15%. He will get a return of 15% because the bond is issued at par, and redeemed at par. The bond is issued at par and redeemed at par. And in such a case, YTM will be the coupon rate. And in such a case, YTM will be the coupon rate. And in such a case, YTM will be the coupon rate. Clear? Full stop. Continue. Because of converting it into share on redemption date, because of converting it into a share, on redemption date, the redemption value is 153.12, sorry, 153.15. The redemption value is 153.15 instead of rupees 100. And therefore, conversion has given an excess return of 2.34%. An excess return of 2.34%. An excess return of 2.34%, making the total return as 17.34%. Making the total return as 17.34%. Clear, everyone? That's all. With this, we have completed complete cost of debt. Everyone understood? First 30% of this chapter is over. Next 10% will be governed by preference shares. Another 30% will be governed by equity. Last 30% will be the overall cost of capital. Okay, that will be easy because that is nothing but calculation of all these and adding. Clear, everyone? First tell me, everyone, 1 yes, are you all comfortable with the chapter? Yes, sir. So thank you very much. We'll meet again in the next class.